So that's what we'll talk about.
Thank you. I was going to do that.
That's fine. All right, let's get started. Wait, I'm gonna share. I'm gonna present.
Oh my head. Where's mine?
So for starters, we have a group called the Home Buyers Clubhouse. You guys can scan that if you guys want to join. We go live every Wednesday and every Friday at 12:30 p.m. We are going to start doing some night classes as well. That's definitely our goal. But yeah, so we have a group. On Wednesdays, we give something inspirational, motivational. On Fridays, we always drop something educational. And what we mean by education is we talk about the home buying process. We talk about the home buying process, anything from credit all the way to home ownership. This is our third city. I'm out of the Raleigh market. My name is Jessie Lynn. Nicole, you can introduce yourself.
I'm Nicole Crawford. I'm a realtor, and I actually am servicing the Greensboro Triad area. So I do Greensboro, High Point, Winston-Salem, all of them.
I do North Carolina, South Carolina. My company does 48 states, everything except for New York and Hawaii.
All right, now we have this working. Let's get started. All right, so today, this is our agenda for today. We're going to go over the 8 steps of home ownership. We're going to talk about our team. You guys, you've met us 3, but there's more. Let's get started. Our mission, the Home Buyers Clubhouse. We created the Home Buyers Clubhouse in 2021. 2021, we created the Home Buyers Clubhouse. Our goal is to empower people about home ownership, to build generational wealth. That has always been our goal. A lot of our events, they are free because this is our way as realtors, as lenders, to give back to the community. We know that so much wealth starts with home ownership. Okay. All right. And I am moving ahead. Let's just follow the screen, Jesse. Follow the screen. All right. So that's me. That's Jesse. That's me right there. That's Nicole. We have a few other people in the Home Buyers Clubhouse. Nikki, she's out of Charlotte. Ashley, she's out of Sanford. Takia, she's out of the Maryland, DC area. Erica, she's all over it. So is Samantha. If there's no struggle, there's no progress. So this is one of my favorite quotes because we all have to start from somewhere. A lot of us started from the bottom and we're just slowly building. Unfortunately, for a lot of us, we get stuck at the bottom. But sometimes in life, you have to struggle to make progress. You have to start from here to get to here. So all of us, we've all had our struggles in this room. So just know you can ask any questions. There's no judgment, none of that, okay? That's what we are here for, to answer all of your questions. So no question is a dumb question. We've heard it all. All right. All right. Y'all want to talk about the home buyers map? You're on screen, ain't you?
But that's all right. I'm fine.
Can you see the home buyers? I get it until y'all get it up. You can see it?
I can.
All right. So step 1.
So you want to meet with a real estate professional. So once you've decided that you want to buy a house, then you're going to meet with your realtor and figure out what it is that you're looking for.
That's the one. All right. So step 2 is to get pre-approved. You speak with.
Yes. So you speak with a lender. So that's what I do. And we take a look at what your financial situation is. We take a look at your credit. We take a look at your debt to income ratio, all of those things, so that we can figure out how much that we're willing to lend you.
And it's also as simple as, yes, sir.
Sorry.
You're fine.
With I know because I was in banking, like with the debt to income, is it like 40%? Like what normally is that?
Different loan programs have different amounts. So there are some, like some government programs their max is 39%, but then you have other ones that will go all the way up to 55.9%. So just depends.
Do they take in account federal student loans?
We do, yes and no. So
Okay.
with your student loans, we have to count 0.5% or 1%. It just depends on the program. So even if you're not making that payment, we have to factor that in as part of your debt to income ratio.
All right, step 3 is
The search for homes. This should be like the fun part. So, and in recent years, it might not have been as fun, but the search for homes is going to be your third step. And then we would make an offer on the house that you find, the one that you fall in love with. Number 5 would be to negotiate the contract. 6 would be once you're under contract, which means that the seller has accepted your contract. Once you're under contract, once your offer is accepted, we're considered under contract. And then 7 is your final details. That'll be your final loan issues or anything that you need to clear up on that side. That's included our final walk of the house that you chose to make sure all repairs were done, that the house looks like exactly like it was when we first seen it. And then, of course, the last step is closing day.
all right. So let's talk about step 1.
The real estate goals. So when you're looking at your real estate goals, a lot of things, these are the things that you want to consider. What are your short-term goals? What are your long-term goals? Like, how long do you anticipate being in this house? How long do you anticipate being in this area? Those type of things. Who's going to be the buyer? Just because you have, so you may have a household, but not everybody may be on that loan. So what's going to be the best option for you? And then anybody who's going to be on the title for that property. How much do you want your monthly payment to be? And then renting versus buying, what that looks like for you, and then the benefits of home ownership.
And what we tell a lot of people is, so with your desired monthly payment, you may want your payments at a certain amount, but what I suggest is, because you never know what the market is doing this thing right here, see how much can you be pre-approved for, your max, and then kind of work your way from there. But I think you said something different, right?
So what we do is we take a look at, this is the maximum amount we're willing to approve you for. But then we also need to talk about what that looks like for your household. Because when I review your credit, what I'm looking at is what's on your credit report bills. But then there are other things that is not on there that you want to consider. Like, I tell people, so if you have a child that plays AAU basketball, or if you have, you give your mama $700 a month or whatever to help her out, that's not something that's on your credit report. So that's something that we need to talk about to figure out, okay, what else do you pay for that is not on your credit report, so that we can help you get a monthly payment that really fits within your budget. So those are kind of 2 different numbers. So just like I may say, based on your credit situation, you qualify for $500,000 for a house. But then when I look at all the things that you pay for or whatever, now we're down to, but in order to keep you within this monthly payment, you need to stick to around $375.
All right, working with a real estate agent.
So working with a real estate agent, there is definitely a difference between a realtor versus a real estate agent. A realtor is someone that has actually took the oath of ethics and been sworn in and went through that, those things, and abide by our duties to our clients and our customers. There are duties that we are held to, fiduciary duties that we're held to be accountable for your money, to make sure we're disclosing material facts, things like that. So your realtors are held to a higher standard than a real estate agent, and not all real estate agents decide to be realtors.
And everyone that sells a house is not licensed also.
Absolutely.
You will encounter a for sale by owner. They own that house, of course. They're representing themselves. You have people that are investors. They own that house. Whenever you go to a new construction site, they are representing the builder. So that's why, as someone out shopping for a house, it's good to have representation. So a licensed broker, you wouldn't represent yourself in court, so you wouldn't go out and try to represent yourself whenever you're buying a home. It's no charge, as long as you make sure that you call us when you see that for sale by owner sign. There's no charge as long as you call us whenever you go into the new construction site. But if you go outside of us, that's when it may be a charge. But as long as we're helping you, the seller will pay us. So it wouldn't hurt you to have a real estate agent represent you. Okay. All right. So search tools. So whenever you decide to work with the real estate agent, you say, hey, I am pre-approved. You have your pre-approval. We're going to set you up in the MLS and you're going to receive automatic notifications. And what that's doing is as soon as something hits the market, let's say 2020 market, as soon as something hit the market, it was gone in like 2 hours. So you want something that's going to send you automatic notifications. Okay, because once you go online, you get off work and then you go on the internet, you see this house, you like it, you love it. Somebody already seen that house and that house is gone, it's under contract. So this is why you want to get set up in the search tools. But sometimes if it becomes too much, you want to contact your agent and say, hey, look, just send it to me once a day or twice a day. So you can set it up however, but it's very important to be set up on this because a lot of these sites that you go to, these homes, they are showing active, but they're already under contract. They sold 3 months ago. Mm-hmm. So this is why you definitely want to make sure your agent is connecting you. Zillow is somewhat okay because they've connected with our MLSs, but a lot of the other sites, they're not, okay? You're also gonna, as your agent, we're gonna connect with the agents in our network. We have realtor groups, we have different things. We also have our websites as well for you to find properties on, which is connected directly to the internet. Also, as far as your customer search, same thing, websites, yard signs, open houses, model homes, your friends, your high-tech tools, your automated home search systems, which we just talked about. And also for myself, I know as an agent, and your agent can do the same thing. If you see a neighborhood, you like the neighborhood, you love the neighborhood, they can call around to that neighborhood to see if anyone is thinking about selling. So a lot of the times, buyers, they're kind of okay with where they go sometimes, but a lot of the time, some people want to be in the same neighborhood with their family, or they just got to be in this neighborhood. So that would be that situation.
And when it comes down to searching, a lot of people feel like, I can see the same thing the agents have. Because of technology, we're working as a team because you can pull up houses on Zillow and Realtor.com, but just understand that we are there to help you to be able to decipher through what you're seeing. And if we work at it as a team, just because you've seen it first before I did, I'm there to help you kind of keep us back in track. Because a lot of times with the inventory being so low, we have to move fast, but we also don't want to waste time on a house that really didn't fit what you need. So we'll start getting to that point of some people get desperate because we've been looking for a little while. So now we want to try to settle, but that's what we're here for you to be that professional to kind of pull us back in and guide us to help us stay on track for what your dreams really were.
Pre-approval, Erica?
Yes. So for your pre-approval process, these are the things that we look at. We look at what's your credit score. Different loan types have different credit score requirements. So most of your government loans, which is your USDA, your FHA, and your VA, your minimum credit score is 580. Your conventional financing, your minimum credit score is 620. Your down payment is also going to vary depending on the loan type. So your USDA is a 0% down payment. Your VA is also 0% down. Your FHA is 3.5%, and your conventional financing can be anywhere from 3 to 5% as far as your down payment. Your closing costs, that's also something that you need to see that you have your closing costs, or that you have those funds available. And so your sources of your down payment and closing costs are going to be your own checking and savings account. You can use gift funds. You can also use like 401k, stuff like that. A lot of times those 401k may allow you the option to borrow from that in order to purchase a house without you having to pay the early withdrawal penalty. So that's something there. Then you also look at your earnest money. So that's also, we want to make sure that that's something that you have. Your interest rates, we know that interest rates are kind of up and down right now. They're higher than they were within the past couple of years. They're still not high. A lot of people are saying, oh my God, interest rates are so high. That's because everything was on clearance for the past 2 years. So it was like, 2%, 3%. So now that they're hovering around 7%, now people are like, oh my God, it's so much more than what it was. But like I said, during this COVID, it was just on clearance. Your loan options, like I said, your conventional, your VA, your FHA, your USDA, all of those are loan options. You have some specialty loan options as well, like they have doctor loans. They have, like depending on your occupation, so they have ones that are for teachers, firefighters. They have bank statement loans, like if you're self-employed. So there's a lot of different loan types out there, but that's something that we talk about then, what is going to fit for you in your situation.
So,
Sorry.
We all have something
because
to
I was
say.
getting ready to say, I was getting ready to bring it.
It's conventional would be like the truest loan, or like a bank loan.
So no, conventional financing is just, so that's just a different type of financing. So it's not, your government loans are then basically guaranteed by the government. So whereas that's why I know you probably have heard, oh, you got to put 20% down on the house. And so that's why you don't have to do that, is because the government has said, hey, listen, because we're doing these particular loan types, we are going to then say, if you default on this loan, then the government will pay us. So then it's less risk for the lender. So therefore that we're saying, you know what, you can do this 3.5% because they said that, if you default on this loan, they don't pay us. So,
They're gonna get the money.
right. So, we will get our money that way. So that's why your criteria is a little bit different.
I have two questions. The first question, when you said credit score matters for each loan, is that whoever's name is on the least, or is it a combination of the two? Whoever has the highest, they'll take that one. How does that work?
It's usually whoever has the lowest.
Oh, okay.
You take whatever your lowest score is. And so just like for families, then you generally want to look and see what's going to be most beneficial, because there are some times where a person may have, this person may have a higher credit score, but their debt is also higher. So then it's like, okay, so now we look at this person. So you can do it together, but it's not necessary that, so as a couple that you put both of your names on there.
Okay. And if we don't, sorry, I have a follow-up question. That's another
Okay.
question. If we don't put both of our names on there
Mhm.
and say he took out a first-time home buyer's loan,
Okay.
if we then wanted another property, since my name wasn't on that house, would I be able to take out the first-time home buyer's loan on the second house because I never?
It depends on if you're married. So if you're married, then both names would be on the title for this property. So even if you're not on the loan, then you would still be
On the
you would
deed.
still be on the deed to this property. And then then you would not be a first-time home buyer. Just because you're not on the loan that's not where your first-time home buyer piece of it comes in.
Okay, gotcha. And then can you just explain what earnest money is? I don't understand that term.
Yep.
Okay.
Yeah, this is, to these, that's your realtor.
So earnest money is a deposit. So you'll hear later where we start really breaking down the earnest money and your due diligence, but earnest money is a deposit that you're putting down for a specific time frame for that seller to take their house off the market. And we used to call it good faith money, but in the process, your due diligence money has come into play. And your due diligence is a fee that's actually paid for a period of time where you're saying, okay, I need 3 weeks to be able to do all my inspections, make sure my loan is correct, my appraisal is done. If I decide I don't want to do any of that and just sit on my thumbs during that time, that's your time to do whatever you want with. So a lot of people you'll hear call it an inspection period. You're paying for that period of time so that if you decide to walk away, you hand that money to the seller for their time.
It's almost like the layaway fee.
You got it.
Okay.
You got it. But your earnest money, typically in North Carolina, our earnest money, and depending on how your realtor sets it up, your earnest money comes in after your due diligence period is up. So normally for me, I'll negotiate 3 weeks to a month for my client to be able to get everything together. And then that period of time that once your due diligence period ends to your closing date is covered by your earnest money. So if you decide to wait till the day before closing to cancel your contract and walk away, you then lose not only your due diligence money, but your earnest money also.
And then if we, proceed with everything, does that money go?
It is credited back to your side.
Okay.
Yeah.
It's a lot of money.
Yes.
Yes.
It's credited back. It's one of those things that tie you to the contract, but it's used on your side once we're clear. Yeah.
It's like a down payment.
You got it.
So when we say, when you get your approval, you'll have a line that says your cash to close. So the amount of money that you need for closing. So that money will then be credited to that. And then, so at the end of it, now, you have to bring whatever it is less your earnest money and due diligence.
And one thing that I want to say about the pre-approval process, this is very important because you need to get pre-approved before you start the process, because you don't want to overshop and you don't want to undershop. So you have to get this done before you start shopping for properties. And also, if you see a property, you like it, you love it, you fall in love with it, and you want to make an offer, a seller is not going to take your offer if you don't have a pre-approval letter. So get pre-approved before you start anything. Right now, you are visualizing your home, you are picturing your home, you are planning for it. But before you start the actual shopping, you definitely want to get this letter.
And a lot of real estate agents, that's their first question is, have you been pre-approved?
We ain't doing it.
We ain't hanging out with you, just, rolling around looking at houses and you can't get approved.
Well, and on top of that, we need to know what type of loan your lender has approved you for, because not every house fits every loan.
Yes.
So if you're going to FHA, we know not to take you in the fixer upper, because we hear clients say it all the time, but I can do a little work, I can do this, but if the house doesn't fit your loan, I don't care how much you can fix it. There has to be something else that goes along with it in order for you to be able to take that loan
And
with it.
VA, they're not dealing with chip
No.
paint. So you can't fix it later. They got to fix that before closing.
Mhm.
All right. So are you ready to buy? Are y'all ready? All right. Who want to do
So
that?
these are the things that you need in order to be able to buy. You need some steady income. You need low to medium debt. You need your cash for your down payment or your closing costs. 2 months of pay stubs, bank statements, 2 years with the same company or in the same industry. So you don't have to have 2 years at the same job, but if you have 2 years of customer service experience, even though it's 2 or 3 companies, then you can do that. But if you have your 2 years of employment history is you used to be a truck driver and now you decided you wanted to be a chef, that doesn't work.
I have a question about that. So what if you work for a company and you're like per diem, or I'm a travel nurse, so sometimes I may take the whole summer off.
Okay.
How does that look?
So we still look at that as we look at your history
Mhm.
as a travel nurse, and then we will look at your contracts on that, and then so we'll take that into
Okay.
consideration, because you're still usually through some sort of company,
Okay,
through some sort of agency is who you're working through.
okay.
So travel nursing is fine.
Okay. So you're self-employed?
No, I work at Atrium, but I could do travel nursing. But it
Okay.
wouldn't be self-employed because it's through a company.
Yeah.
Yeah, so I would never.
So travel nursing is a different that's a different beast. So
Yeah.
yes, no.
Either
you're
one of
fine.
y'all self-employed? Okay, we don't have to go into that. Okay.
No.
Overtime, y'all get overtime? What about overtime? Yeah, a lot of overtime, Erica?
So with yours, how long have you been a travel nurse? How long have you been a
I'm not
nurse?
a travel nurse, but I would get into travel nursing too. But I'm a nurse practitioner at Maine, and I work per diem, so I technically am not salary.
Mhm.
So I do get overtime.
But how long have you worked there?
At Louise about 1.5 years now.
Okay, so usually in order to be able to count like overtime, then you're looking at, you need 2 years worth of history of having overtime.
Mhm.
So just like we would need like your W-2s for the last 2 years, so we can see that, okay, traditionally you get an extra $15,000 in overtime on a yearly basis.
Mhm.
So then I can count that. But without that, then I can't count that.
Okay.
So that's money that you then can't count.
In
But even
part-time
if you-
jobs.
Right, it's the same for part-time jobs. But if you have a history of having it, like if the job that you had, whatever, before you worked at wherever you work now, if you also had a history of doing it, then, we can count that.
All right. Any more questions? All right, let's go. Let's go. Okay, let's try one more time, girl. There we go. See, we're moving ahead. People don't know how to follow the screen, boy. Go ahead.
Getting pre-approved. So these are the things that you would do in order to get pre-approved. You would choose your lender, you would fill out your loan application, and then we give you your, in order to get your approval documents. So for us, we underwrite you before we issue your pre-approval letter. So I collect your pay stubs, your bank statements, tax returns if you're self-employed. Now, also keep in mind, self-employed, a lot of people don't realize if you are doing DoorDash, that's self-employment. If you are doing like any type, like those type of things, Uber Eats, Uber, blah, 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 all of that. So we check proof of employment. We want to make sure, we'll call the work number, or we'll check to make sure that you are employed. And then you do have to have at least a 580 credit score. And also keep in mind, when you are doing like getting your pre-approvals, when we look at your bank statements, we're looking for things that may not appear on your credit report. They're looking for, like, we don't care that that you're spending $10 at, whatever restaurant every day. We're not looking for all of that, but we are looking for things that are not disclosed, like that you're paying the IRS every month. Then it's like, okay, this is a debt that was not on your credit report, but this is something that we need to count.
And one thing that Erica said, that like with her company, they go ahead and pull your paycheck stubs and your bank statements, because they want to make sure when they issue that pre-approval letter that they have as much information as they can, so you can shop in confidence, with confidence. A lot of companies don't do that. They go off your verbal, which is what a lot of people will get, that pre-qualification. If they're not taking and pulling all your information, you need to ask them, can you look at it? Because you don't want to get out here and start shopping and you get under contract, and then that's when all the questions start coming, because they didn't realize on your tax returns, even though you're W-2, you're still writing off stuff. So those are things that have gotten a lot of people in trouble later on, and we don't want you losing your money.
So yeah, I've seen people lose their due diligence because they've used these online companies, VA, different types of companies. They are self-employed. They go under contract. They put up their due diligence money. That money is non-refundable. So the seller has already cashed your check and they already have your money. So you definitely want to make sure that you are working with the right lender to pre-qualify you, pre-approve you up front. They're verifying everything, because you don't want to get all the way under contract and then you have to back out and then you lose that money. To be prepared, Erica, what do you need, girl?
Well, in order for you guys to prepare before you meet with the lender, do you know what your credit score is? Now, I know a lot of people use like Credit Karma, things like that. Keep in mind that that is not the score that we use when we are loaning you money. So that is a Vantage score. And then sometimes even through a credit card or something like that, then if you look at the fine print, they will tell you what kind of score that they are giving you, whether it's a FICO or a Vantage score. So Vantage scores is what we don't use to lend money. So everything is going to be based on a FICO score as of right now. They're talking about changing that at some point this year, but right now we don't have a date as to when that's going to happen. So everything is still on a FICO score.
What, changing that to Advantage as well?
So they're right now they're talking about doing it where they will do a Vantage 4 score or a FICO score will be the options that they go with for that. And as I said, at some point this year, that's supposed to be in the works, but you know how government bureaucracy is. So have your pay stubs. You'd be surprised at how many people don't know how much money they make. They know how much money they get in, but they don't know how much money they make, because we go off what your gross is. So if you make $22 an hour, then that's what I'm taking. I'm not taking the $1,500 or whatever that you actually bring home. So so that's what you look at there. And where it says know your credit score, you can actually get your credit score. There's a cost associated with it, but myfico.com is where you would go in order to get your credit score. And so we look at all 3 credit bureaus, and then we take whichever one is in the middle.
If I looked up on my credit union, is that?
It depends. So you have to still look and see, because they will tell you what credit score that it is that they give you. So
So is that okay? Is that where I'm at?
Mm-mm.
that's what I'm saying. It depends.
Okay.
So
And I can probably tell you, no.
Because usually with the credit union,
They only pull one.
like one. They only pull one. The lenders, they usually pull 3. They're going to pull your 3 scores. They're not going to choose your highest. They're not going to choose your lowest. They're going to choose your middle score.
and that score is going to be different. The credit bureau that reports that is going to be different for everybody. So just like for you, that may be your middle score, but then for her, that may be her highest score. So we don't know what that is. So But I think if you're talking about state employees,
It's actually founders.
okay, so I don't know
I don't
which
know about
one
them.
that they actually use.
And state employees have started pulling all three.
What?
Oh, good.
They just started at the end of February.
Okay. So that's what that is. And then when it says keep your debts low. So when you're starting to think about buying a house, this is the time when you want to connect with your lender, because we want to, take a look at your credit report so we can say, so sometimes you may be looking to buy a house 6 months from now, but let's go ahead and take a look at your credit now so I can see exactly what it is that you need to work on. So, because it could be that, okay, in order for you to get where you need to be, I need you to pay off this card or, blah, 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 those type of things. So we can come up with an action plan as to what works for you.
And if you're thinking about buying a house anytime soon, don't go out and buy an expensive car. Just don't. A lot of people, they discover they're working so hard to get their credit right. They're working hard to get a house, and then they get excited or they're denied. And instead of them going to another lender to check their options or working on what they need to work on, they get discouraged and say, oh, well, I can get a car, and then get a car, and then you have to start all the way over. Or, you're going to have to start over. And then your debt to income ratio is low, so which is affecting your affordability. Now you were approved for a $400,000 house. Now you're going to get a $300,000 house. So just if you can hold off on getting that new car, getting that new furniture, different things, just hold off until you get those keys.
I always say the house before the car.
Mhm.
Just because your criteria are different. Basically, with a car, they just want to make sure you make XYZ times the car payment, whereas with a house, you can only have so much debt in order to be able to get this. Because, with a car, a lot of times they don't really care how you work this out, as long as you make this money. They're like, listen. And so ask questions. So I will also say, one of the things Jessie Lynn said, different lenders have different requirements. So just because you went to your bank and they told you no, does not mean your answer is no. So they could be, as I said, for us, it's 580. But a lot of your, like I know Bank of America, their minimum score is 620 for an FHA loan. So it just depends on where you go and what their criteria is. So, and ask questions when you talk to your lender. Ask about your score requirements, ask about first-time home buyer programs, interest rates, down payment assistance, all of those things. And then, so they should be telling you if you're not able to get approved, then it's like, okay, what do I need to do to get approved? Yes.
I know, it's more common like nowadays, like once you get the loan through whatever bank, then they automatically sell it off.
Yes.
In any way does that affect you, like during the process, maybe like, because everyone like refinance or what have you to get a lower loan. I guess my question is like, in any way does that affect you in any type of like negative way if they sell it off? Just keep selling it off.
It doesn't, because you have to remember they answer to their investors, and that's what they do. They put all of these loans into a bucket and tell somebody, hey, I'm going to sell you this bucket of loans. And then they keep doing that. But that has no effect. That has no effect on you at all.
It won't change the terms or anything that you signed for when it comes down to your house.
Because when they do it, they sell like this entire block of loans. And so, and that's also why a lot of times the criteria is different at a bank versus a mortgage company. So like I work for a mortgage company, not a bank. So the bank is answering to their investors who then say, okay, well, we only want to buy what they call A paper, B paper, whatever it is, based on the credit score, all of those things. So then that's their criteria for how they approve loans, is because we want to own, we don't want to buy anything. We don't want to approve anything that we can't sell.
And as realtors, we can help you to be able to figure out what lender can help you, especially if you're upfront, because we work as a team. So when we're sending clients over to Erica, we partner together to make sure that you're getting the best. And so we want to make sure that if you talk to us and tell us your scenario and what's going on and share with us what you have for as down payment money, then it helps us to be able to help you to kind of to say, well, this, I know this company does this has this, and this has this. And then that way you can make a better decision, but you're always welcome to use whoever you want to. Okay. So step 4, going home shopping. So the thing about, typically this is where a lot of times I start in the beginning and sit down and have a buyer's consultation with my clients. But in that consultation, that's where we're talking about the type of home that you're looking for. Do you need 1 or 2 story versus a ranch style home? Your schools and demographics and things like that. What kind of market you're looking to be in. One thing about realtors, and a lot of people will say, well, they're just sending me the same thing. Well, we're sending you what's out there, but also we can't, if you say, I don't want to be in the hood, which is something we hear all the time, we don't know what the hood is. What's an undesirable neighborhood for us may not be undesirable for you, and we can't steer. So you have to let us know where you want to be. If there's specifically somewhere where you just desire not to be, you need to let your realtor know that, because we can't tell you where to live. It's against the law. And so our job is to make sure we're setting up showing appointments, making sure we're helping you to narrow down your search. I would rather, a lot of people say I would rather ask you 500 questions and only show you 5 houses than show you 500 houses and I didn't only ask you but 5 questions. So, we want to make sure we're drilling it down, because it's amazing how a lot of times people don't know what they want. A lot of people will sit and give me a list of things that they've seen on HGTV, but it doesn't fit their lifestyle once they get in. And people get tied up into trend things, and they'll say open floor plan. And I've walked so many people into houses that I'm like, oh, this is open. And they're like, I don't like this. You can see everything. This is what open feels like. Yes. So as we walk through, once you get into houses, you start seeing things that you really do like and you don't. But as our job is to start getting down and narrowing your list down so that we can find what you want and not waste a lot of time going in houses that don't fit.
When we first got into real estate, they always tell us to do property previews,
Mm-hmm.
check out the properties, go to different ones, different areas. Do that. Go to open houses, get a good feel of what you want, because this plan may not work for you.
Yeah.
So just do it now.
And it looks pretty online, but
Yes.
the flow of the house may not work for you. And you want to know how far neighborhoods are from work and whether it's going to make sense for you to move into that neighborhood.
And I feel like you also need to make your list wants versus needs.
Mm-hmm.
So there'll be some things that you have to have in a house. So make that list. But then also make the list of, these would be some things that would be nice to have. Like if you have to have 4 bedrooms, then okay, that's what you want to put on your list. Some of the cosmetic things are things you could change later. So just like if you want granite countertops, okay, that's something that you can always change once you get into the house. But you can't add more square footage to a house unless you're doing an addition. So, but if you know you have to have these 4 bedrooms, then that needs to be your criteria.
And so the next one is understanding what you're looking for. So you want to make sure you kind of have an idea of what the location is, the price point when what you're looking for. And this is one of the big reasons why as realtors, we don't take people out that are not pre-approved, because that price matters. We're out here showing you houses that are above your budget, and then you get that pre-approval letter and you can't afford that price point. It's hard to come back down. It is so hard because you've fallen in love with something and now you're trying to fit it into a bracket that it doesn't exist in. It's hard to come to really do that. So you want to kind of have an idea of square footage in your bedrooms, your bathrooms, the style of house that you like. Some people know they don't do steps. So that's something that's really important in the schools. One thing we can do is we can give you the resources to find the information, but we can't steer you towards schools. So if you know there's a school district that your child needs to be in, you share that information. But a lot of times we'll get those questions. Well, what about the school district? How are they? I don't know. I can tell you where to find it though. So making the offer, you want to make sure that when you're talking with your agent, their job is to make sure that you're making the best offer that you can at the time. So we want to make sure that everything on there, as far as contingencies is anything that is dependent on. So you're buying a house depending on your loan. You're buying a house, but you want to make sure that the repairs are done. So that's what your contingencies are. It could also be, I'm buying this house, but it's contingent on me selling another one. We are there to make sure that the contracts, going over the contracts with you, making sure we go over the disclosures with you. Every house in the state of North Carolina, except for foreclosures, new construction, they're supposed to supply you with what we call a residential property disclosure. And that's something that's filled out by the seller. But understand that North Carolina is a seller beware state. And so they don't have to answer all the questions on there. They can put no representation on there. But it is our job as a buyer and your buyer's agent to find out as much as we can on those properties, because the seller technically does not have to disclose it. Multiple offers, we've seen that in the last few years. And what else was it?
Sorry.
Executed contracts is when we have that accepted, you're fine. And then, of course, the earnest money.
And y'all know what the earnest money is, right? So again, we talked about the due diligence and the earnest money. The due diligence is kind of like, will you be my girlfriend or will you marry me? The earnest money is kind of like the actual ring. So it's both. But the due diligence fee, again, is non-refundable. It's not refundable, but the sellers like the due diligence fee. Why? Because they get to keep that money. So the earnest money, again, you can get that back at the end of your due diligence period. What do we recommend? People have a fit when they see this, but the market is changing, okay? But we do recommend 1% of each, but with the change in market, depending on the area, you may be able to get away with around just 1% split in the middle, okay? But it just depends on the market. Inspections, they're going to cost anywhere between $300 to $800, depending on the size of the property. Your appraisals, same thing, $500 to $800, depending on the lender. The lender, they usually order those. You will order the inspections. They are not required, but we highly recommend them. The appraisal, if you're getting a loan, is required. If you're paying cash, you don't need it. Well, you do, but it's not required. Closing costs is about 3%, not always, about 3%, but the lender, they're going to provide that up front with the guesstimate, and Erica can talk to you about that in a second. Your down payment is about 0 to 20%. So up front, we recommend that you save about 5% total, depending on whether you have down payment assistance or not, because they do have down payment assistance and different things out there, but you're still going to need money for the inspections and, of course, your appraisals. You want to talk about the closing cost estimate, or are we good on that?
I can, sure.
Okay.
So your closing costs is going to be things like your attorney fees, your lender fees, your title search. All of that is part of what what encompasses your closing costs. And then we also do 3 months worth of homeowners insurance, and then whatever your monthly payment is going to be for the taxes. So we include taxes and insurance on your loan. Any government loan, you have to include the taxes and insurance. On a conventional, you don't actually have to. However, your interest rate is higher because it's more of a risk to the lender.
Go ahead.
I was gonna say, is it a fixed rate or does it fluctuate?
It depends on the loan type. We just do fixed rates, but just like some credit unions, I know they do adjustable rate mortgages, which means that, so like if they say it's a 5-in-1 ARM, so that means for the first 5 years, that interest rate is going to remain at whatever you got it at. And then after that, it can adjust once every year after that. So it can go up. So you got, let's say if you got a loan a few years ago and got an ARM, then maybe you got a 3%. But now this may be your year for it to adjust. So now it's going to go up 1%. And it's going to continue to go up that 1% until it hits that cap based on the rates.
Most people refinance before then, but
Right.
it just depends on the market. For me, I had an ARMS with my property, but luckily when I refinanced, the market was around 2%.
Mhm.
So, but you never know. But you could always refinance if the interest rates are too high. So you'll know right before then.
Now, when you refinance,
That's my
but keep in mind, you have to, so a lot of times you have to do another appraisal. You have to do another appraisal. You also have to do your closing costs is, you have to pay for all of that again once you do your refinance.
Hello.
You said you have to, I'm sorry, you said closing costs, what else you have to do?
And your appraisal, when you refinance,
Okay,
you're paying for those things again.
okay. If it's a new build, do you have to pay for inspections and appraisals since it's city limits?
You still have to pay for an appraisal either
Okay.
way because we have, an appraisal tells you how much the house is worth.
Okay.
So you have to do the appraisal. The inspection is not required on any of it, but I highly recommend an inspection on any, because an inspection tells you what's wrong with the house. And and I'm sure you've seen videos on TikTok and IG and all of that of the horror stories of this new construction house
Okay.
that, wasn't built correctly or whatever. Exactly. So those are things that you want to know before you get into this deal, because this is a $300,000 purchase.
Right.
So you want to know everything, and the inspection is going to help tell you anything that's wrong with this house, as much as they can tell you.
We've done a survey with some inspectors, and one inspector told me that he done an inspection on multiple properties in the same community, and most of them were missing the attic insulation. So it's different. It's things like that that you can't believe that they're missed, but they do.
And with new construction, if you do your home inspection before, typically they will fix everything on there. They don't want for you to go into it with these things kind of lagging or out there that need to be fixed. So it's a good time to have them to fix it before closing. And then, because a lot of times you're thinking, well, they'll come back in a year. But if I have an instance where your dampers were never opened or something like that, that's a whole lot of electricity you've wasted over that year, and now your bills are higher. I've seen where toilets was not, the caps weren't removed, and now you got water running on the backside of your wall. So those are things that they can catch a lot of times before you close, and then you don't have to worry about the issues that it causes.
All right. So you found your house, you love your house, you like your house, you are ready to make an offer on this house. So once you find your home, we're going to contact the seller. Hey, Mr. Seller, how are you doing today? Great. Well, we're going to contact the seller's agent, and we're going to find out how soon do they want to move. All sellers don't want to move quickly. They may need more than the normal 45 days that it takes to close on a property. So we're going to find out their wants, just so we'll know how to prepare the offer. Number two is we're going to talk to you guys about the earnest money that you guys already know about, your down payment information, your important dates, which are your due diligence dates and your closing dates. Due diligence period is about 21 days. The reason you're doing that, during your due diligence period, you are ordering inspections, you are doing whatever you need to do, you're negotiating with the sellers, you're doing whatever you need to do during this time. After your due diligence period, you have your closing. Again, it could be anywhere between 30 to 45 days. What comes with the home? A lot of people don't know this, but the fridge does not come with the home. So if you walk through the property, take a photo of the fridge. Your realtor should, if you want the fridge, just say, hey, look, I want the fridge. Does it come with the house? If you want the washer and dryer, same thing. That does not come with the home. The range does. And then once you make your offer, it will be accepted, countered, or declined. A lot of people, they want to go in and they think it's going to be like a back and forth thing. You want to make your offer with your highest and your best. Why? Because people they are still receiving multiple offers in this market. So you want to go in with your highest and your best. No matter what, your agent, they're going to pull some comps. And what the comps are is basically what the homes are selling for in that neighborhood. We're going to give you a range, and we're going to say, hey, look, the homes of this same size, the design, and the condition, they are selling between this price range and this price range. This is what I recommend that you offer. And then you choose what you want to offer. We're not going to tell you. Any questions about that?
And I was going to say, doing multiple offers, because the market, as we get back into our spring, which we're in, and our summer market, we're probably going to see more buyers starting to come back out. These are the things that your realtor are going to be looking at for you to make a decision on, what price, how many dates. And these are the things that we start moving around. When you have multiple offers, it tends to shorten your time period on your due diligence, because you want to make sure that offer is clean enough and quick enough that seller is putting you at the top of their list. So you might be giving up more earnest money and due diligence money. And that's the market we just came out of, that we've kind of been living in for the last 2 years. You may not ask for their refrigerator because it might make your offer a little bit more streamlined, and they don't have to worry about buying another one when they get to their new home. So those are all things that are really negotiable, and your decision on what you want to do with it.
Okay. All right. So we just talked about an estimate on what we recommend whenever it comes to making an offer. So if you find a $400,000 house, you're gonna do, let's say, 1% due diligence deposit. That's $4,000. The earnest money is about $4,000. You're gonna order your inspections, your appraisals. That's gonna be about $9,300, right? So, I thought I had another slide. Did I go too fast?
Mhm.
Sorry, let me go back. It didn't pop up.
That's it. See mine.
Your offer breakdown?
Mm-hmm.
Well, is it out of order?
I think it must be. I don't think that's how
Tap
we do it,
yours.
guys.
Do the offer breakdown so we can show them how much. It's not showing?
Mm-mm.
Oh, that's crazy. All right. So we had an entire offer breakdown on how much you were going to bring to closing, but since we are on the wrong screen, we can't show it to you. But with your offer breakdown, as you can see up front, you are about $9,300. If you had an FHA loan, it's about 3.5% down.
Mhm.
So then you're going to subtract that 9,300 from your down payment plus about your 5% closing costs.
Yes.
Yes,
So-
there you go.
Yeah, it's another slide.
So it's another one's out of order.
Mm-hmm.
Okay, that's what it is. Let me go up. How many up is it?
I think 2 or 3.
2 or 3?
Yeah.
Well, let's just talk about this and then
Yep.
we'll go to it. All right, so you see, after all of your inspections and after all of your appraisals, you are at about $9,300. Once your offer is accepted, you're going to give your earnest money to the title company. You're going to order your inspections and your do your repairs. You're going to negotiate that with the seller. A lot of people think that the repairs, just because they got an inspection, that the seller can do their repairs. They don't. They're not required. Again, it's a buyer beware state, so the sellers are not required to do the repairs. But that's where you negotiate. Okay. And a lot of the times when we walk our clients through the property, we're kind of looking. A lot of the spots that we're looking in the closets, looking for like little leaks, things that may be hidden. But again, we're not inspectors. That's why you're getting the inspection. But repairs are not required to be done by the seller. Okay.
So you just kind of negotiate that within the price you're saying?
It could be a couple of things. So when you're negotiating repairs, you can negotiate for them to come in and do the repairs.
Mm-hmm.
And a lot of times I tell clients to look at how their upkeep on their home is right now. Do you want them to make the repairs for you? And that can be, you take a credit for the repairs and come up with a dollar amount. And a lot of times when we're negotiating repairs, we'll send somebody, our contractor out there to see how much it's going to cost, because we want to know what we're doing. And I always tell clients, go for the big stuff that you know you can't afford to replace. Don't nickel and dime on the little petty stuff, because your home inspection will have everything. You're hiring them to find everything they possibly can wrong with that house. But I always tell you to be mindful. If you decide to take a seller's credit for your repairs, 9 times out of 10, you're not seeing that money in your pocket. That means that they're going to use that money towards your loan, and then it just saved you a little money from coming to closing with it. So a lot of people think, oh, well, they're going to give me a check for that $5,000. That's typically not how it happens unless you have some kind of escrow or anything like that. But a lot of times, if it's from my clients, if it's something I know they cannot fix and we negotiate money, I have the contractors understand we will pay them at closing. They will come out right before closing, fix it. They get paid at closing when everybody settles.
Okay. Any more questions about the inspections?
The previous spring, where it said $400,000, that's only if that house.
That's just a
So
guesstimate.
it just lowered, lower.
Yes.
And all of that's negotiable. So it doesn't have to be 1%.
Mhm.
During the market before that we just came out of, we were seeing a little bit higher than 1% on
Mhm.
houses. But if we were giving up that kind of money, we were not giving up earnest money, because technically for the seller, they want to tie you to the house. So the due diligence is what matters to them.
Yep.
So we were seeing crazy numbers in that field, because sellers were, if I have 30 offers on my house, I want to make sure that once I get you under contract, you're not going anywhere.
And this is why it's important for you to have those conversations with your realtor and your lender to let them know how much money you have up front. And then that way we'll know how to structure your offer.
Mhm.
If we need to put more towards due diligence and a little bit less towards earnest, we can do that. But just be honest with your realtor, because we're here to help you.
Yeah, we're not trying to really be nosy like that,
Yeah.
but we are trying to make sure that once we get you out there is nothing like getting somebody out there, get them under contract only find out they really don't have the money that they said they have, and it's time to hand over checks, because that seller is going to cancel that contract within 24 hours.
Yes.
You got it.
Okay. You're paying them to take their property out the market and do your inspections.
Yeah, or you don't have the money for the appraisal and we're waiting for your next paycheck. That's 2 weeks we could lose.
I've seen.
Yeah. We speaking from experience.
Now, I will also say, as far as like your earnest money, your like that kind of thing, like I've seen, so I've seen less than the 1% as well. So
Absolutely.
I've seen $500 is what they got for what they put down for that, but that's going to depend on the market that you are looking in. So that may not work in Charlotte, but that may work in Greensboro, or that may work in a different city. So it just depends on what it looks like, but that's where your realtor comes in, because they can tell you what they're seeing out there.
And a lot of times it breaks down to per house. I mean, we can have like in Greensboro, we have a market now where we're seeing multiple offers over here, but over here I can get you under contract for $500 like I did. And then maybe a couple of $100 in earnest money. And of course, as realtors, that's what we want to see and help you do, but it's not always possible, because if you're looking for that HGTV house, you're giving them some money.
You need some HGTV money.
Yeah, you need a little money to go with that.
All right, we're gonna finish this section and then we're gonna let you go to break. All right, so let's go. So your home insurance, that needs to be sent over to your lender about 2 weeks before closing. And then you're gonna finalize your mortgage details. We're gonna do your final walkthrough. This is very important because we wanna make sure the house is still there. The house could have burned down last night and you're closing on the property that's not even there. We also wanna make sure there are no damages. We wanna make sure that the repairs are done. So you wanna do your final walkthrough. I've seen somebody say, no, I don't need one, but you need to do your final walkthrough.
I will say I had a person that was selling a house. They went to go do their final walkthrough. It was in the wintertime. The pipes had busted the night before and the whole house was flooding.
Yep.
So, but that wasn't something they would have known unless they went to do this final walkthrough.
And that's why, as realtors, you may say, no, you're not going, but we going.
Yeah.
Because we don't want to be liable for you.
Paranoid about it. Like, are you sure? You know what?
You're not closing on a loan with me, on a house with me, and we haven't seen it right before close.
All right, so we're gonna send y'all on your break. We have it's 8 steps. So we have 2 more steps to go through, but we said an hour. You're gonna need it. And then we'll do
The rest of this.
6 through 8, right?
Mhm.
Yeah.
Yes.
All right. And then also in this section, we're gonna break down the closing costs. I think I did that for a reason. So okay. The bathroom is right down the hall to your left if you want to go, and it's a 10-minute break.
So we'll be back at.
Hey, Facebook, y'all got any
12:20.
questions? 12:20.
Yes.
Yeah, 12:20.
Are you allowed to?
Yeah, I said, why Erica's not on here?
Oh,
Facebook.
I thought she was up there. Oh,
Erica's
yeah.
not up here.
I didn't even know we was doing it.
I told you you were, girl. I said Nicole sit in the middle, remember?
You did say that.
Yeah. Boys, what kind of charger you got for your laptop? Is it the seat? Is it the seat port?
Yes.
Can you introduce yourself? Because she's not
Yes.
sure who you are.
Yeah, well, I know her. I'm Erica Batts, so I'm your mortgage loan officer. And then here,
I'm Nicole Crawford. I'm a realtor out of Greensboro Triad area.
I am Jessie Lynn. I am a triangle realtor. So
Do you stay around?
I do not. I drove. We go to each city. The Carter's Clubhouse. We're in like 4 different parts of North Carolina. So
But Jesse lives in you're in
I
Clayton.
I'm in Clayton.
Clayton area.
Clinton.
Clayton.
yeah.
Clayton. Oh,
Mhm.
right
Yeah, are y'all in Raleigh?
That's your first
I'm here.
Okay, where you in
It's too
Raleigh?
big for you.
right off of Buffalo
Yeah,
Road.
I have a seat.
Okay,
Like,
you're not
like,
far from it.
wow.
You're not from, so I live right behind,
Girl, I
the,
got in the
Chuck E.
car.
Cheese. Okay.
Oh, okay, yeah.
Back in
So right
the
there.
house. So well, let's look up this address.
yes.
Couldn't figure it
So I
out.
just
Later
moved
on,
here,
I got here.
like
How much are they?
in, I moved July of last year, but then I got to actually Charlotte in, like November.
How you like it?
I like it so far. It's like, I'm trying to get used to all these little pockets. Like this Noda and this and that. And it's just like, oh.
Yeah.
You will.
My daughter said,
So good to see you.
my daughter said, when y'all done, can I get another chicken?
Good to see you.
I'm don't
Yeah,
feed a
that's
full
something.
child.
You did? You
My,
said
my,
you
my
said-
church meeting, it went
That's
over.
all right.
You said, I said, my sister said, she was like, no, still come.
Yes, that's definitely come. Yes, no, we're here until, it's a 3-hour thing. I told you,
Okay.
we
Okay,
deep dive here.
All right.
So,
I just had a quick question.
Yes.
I don't know if I want to ask after the break or whatever.
what's,
But
so you
like, I know someone at my job, I work
Okay.
at county. They bought a house with zero down. So is that really reality? We always hear that first time home buyers, zero down.
So it depends on what kind of loan product that you do. So there are some, okay, so but keep in mind, zero down does not mean no money out of pocket.
Mhm.
So just like zero down may be a zero down payment, but you still have to come with your closing costs.
Okay.
Like there is also some,
Because when we hear zero down, that's what we're thinking.
Yes, a lot of
So
people.
that's why
So I don't know, so I'm just
I
asking.
like to make that clear. It's
Okay.
like zero down does not mean you don't need any money.
Okay.
That means you don't need money for a down payment, but then you still have to pay your closing costs, all of those fees will still be a part of your package.
Okay.
So, yes.
So what else would it be if you got into a loan that was a zero down payment?
Mhm.
I don't know, the guy that bought a house worked for the county, and I think they had like an incentive for first time home buyers, a government employee. So if I was to qualify for something like that and I get in the home with zero down, what are my closing costs?
So closing costs are gonna be different for each loan type,
Okay.
but, keep in mind, so generally your closing costs are still probably gonna be anywhere from 3 to 5% of your purchase price. Because you still have to pay for it, your insurance has to be paid for upfront, your taxes, all of that, your attorney fees, all of those things still have to be paid for.
And the attorney fees, I don't even know anything, or like, how do you even start? So like, is that something your realtor will help you with?
Yes, so no, we do that as far as, so there'll be certain services that you can shop for, certain services that you cannot. But that's all part of your disclosures. So there's a whole section right there that says services you can shop for. So just like, so I usually put in, most attorneys around this area like $800 for their attorney fees, somewhere up in there. But then you may find one that says, hey, I can do it for $550. Cool, you can use that person. So that's something that you would have to look at.
So if I wanted to you, I'm working with all three of you, just working with you, or like?
So we do different things. I'm the lender, so I'm your money person.
Okay.
So Nicole is the realtor out of the Greensboro area, and then Suzanne is out of the Raleigh area. So I can connect you with a realtor that's in this area if you don't have one.
Okay. In Huntersville? That's
Yes.
still this
Yep,
area.
still this area.
Okay.
With, you know,
Because Greensboro,
And
an hour.
And yes, it's a little bit over hour, yeah.
Okay.
And I used to come to Charlotte, but because of the way the market is, it wouldn't make sense. You need somebody that's here because a lot of times you need to get in the houses that day. And I can't always promise that my schedule and driving an hour and a half would make it.
And I generally recommend, like, because, you know, there's some people that do it on a part-time basis, some on a full-time basis. I usually like to steer towards a full-time agent just because of the craziness of this market.
Right.
When this house goes on the market and you need somebody to look at it, it's like, okay, by the time you get off work and that other person gets off work, the house is already gone. Where you need somebody that's like, oh no, I'm going to go look at this house now,
Exactly.
and I can show you a video tour or whatever, and you can decide if you want to put in an offer.
Because I hear y'all saying a lot about selling. What's the difference between when you go in the new construction and they're selling a house? That's different, right, than a seller?
Not really,
Not
because they're
really.
still selling the house.
Okay.
Mhm.
Okay.
So I think
But
that,
like when you're saying you want to make an offer, like they already have what their houses is going for or selling.
True, but in a good market, it's still negotiable. In
Okay.
this market, doing this, we're starting to see incentives come back.
Mhm.
So on their new construction, you might get a third, you can use that for closing costs to buy down your rates. You can use it in their design studio.
Okay.
Yeah.
But that's how they work.
Yeah.
that is how they work. But keep in mind, when you go into these new home communities, you be going with your realtor,
Mhm.
or, you know, or at least your very first conversation, you need to say, hey, I'm working with Nicole, or hey, I'm working with somebody, because they need to know that you have somebody negotiating for you, because they get paid by whoever the home builder is.
Okay.
So even though they're saying, oh, you don't have to have one, you know, they basically say that because they're like, oh no, we can represent you on both sides. But if this company over here is giving me my paycheck every month, and then this is gonna be a one-time deal for you, who am I looking out for?
Right.
So those are the things that you want to look at.
Okay.
So
So
Yeah,
you're
we on our break.
looking
We'll be back in 4 minutes.
you would impact.
If y'all have any
with
questions,
the
let
real,
us know.
so I'm your money
Oh,
person.
not you.
So here is our sign-in sheet. So if you guys could sign in there.
That's okay, Erica. I said, we can just send out a referral, so we got referral fees. It's qualifying, I get it.
Yeah, yeah, this is really helpful. I'm glad. I kept asking people, like my friends that have just like jumped into my house. I was like, well, how did you learn? Like, who you talk to? It's like, oh, this Google stuff that I just kept. And then all of a sudden, I was like, oh, this is gonna look like me. I want to teach you how to
Yeah, I
do
didn't.
that.
Absolutely.
So let's go.
I
Well,
got
and the
that
thing
text
about
message.
Googling is what you find is, and you may find accurate information, but you may not find information that applies to you. So
Yeah.
that's why you want to, work with your
Yeah.
real estate agent, your lender, because it's like, so I can tell you what applies for your situation, because
Right.
what applies for you may not apply for them.
Yeah.
And a lot of,
was-
I was gonna say, I'm sorry, go ahead.
No, it's okay. I was just like, I wasn't looking. I think a lot of people, I think I didn't know what I was looking for either.
Exactly.
And I was like, I don't need to know, is there a loan out there for me? I'm sure there is. I need someone to teach me what is the closing cost?
Right.
What is, or I don't know what these terms
Right.
mean.
Mhm.
And y'all, so I was like, I need a workshop. I still am like very lost.
That's okay.
We'll
Keep
get
in
you.
mind that
Ask
our
those
job is to
questions.
Hold your hand and get
Yeah.
you through this process. Like we do this every day, you don't. So it's like
Right.
if I got a question about nursing,
Yeah.
I can WebMD it, but
Yeah.
no, I'm gonna come here and be like, hey, listen.
Yeah.
It's your expertise.
Exactly.
Because I thought I knew from HGTV.
Yeah, and plus you're getting general, so
Yeah.
and it depends on where they are when they're doing HGTVs and those kind of things. A lot of things are different. So even though one of our slides said we give it to the title company, North Carolina is an attorney state, so you're going to be working with an attorney to close your property. Some of that they might be doing the signing agents and things like that, but you are turning your money over to an attorney and those type of things, and not every state is like that. So when you Google information, sometimes it can be so broad that it still doesn't make sense.
This is just all new.
Yeah, each state is different.
Yeah.
And
So much.
we've seen some states, they close and they don't get the keys. You get the keys the same day in North Carolina once it records, but people don't get keys like months later in some states. So
Wow. Yeah, this is very, very helpful. And again, coming from people that, look like me.
Exactly.
Very helpful.
Well, that's one of the things that's
Thank
important is
you.
just to be able to educate
Yeah, no.
people. A lot of times we don't know about stuff, or like you say, you first generation, and it's like, but then once you do
Facebook
it,
user.
somebody else in your family. Yeah, I can do this.
We'll be back in about
Yeah.
30 seconds, y'all.
Okay.
Sorry.
And you said that you worked in banking. What did you do?
I was a relationship banker at PVT.
Okay.
I'm at medical advice now. I work at Invisalign.
Okay. I've heard Invisalign is a good company to work at.
Nah, I mean, overall, they're treating me well. I guess. We trying to figure out, she gonna move to Raleigh or I'm gonna move to Louisville.
Yeah.
So
Okay.
we'll be buying it North Carolina.
That's my
Okay.
market. That's my market. Call me.
Yeah. Raleigh.
Well, see, the
is-
thing is, both of those areas are hot. As a matter of
Yeah.
fact, I just saw a thing that,
Yeah.
that Raleigh was the,
We're like top 5 on this list.
exactly.
Yeah.
Oh,
So, and that was,
Number 1 for women to work.
I was gonna say, I just saw that. It said,
Very tricky there.
for women, yeah. And then,
Right by the beach.
well, because it's halfway. We're kind of halfway in between, so it doesn't take you very long.
I went to NC State, so
Okay.
not only where my heart is, but
But and really not, it's sitting next to you.
I also
Which is
love-
why you're here.
I also love Toronto too. Like,
Okay.
basically back and forth for the past 10 years there too. So I've seen it grow, seen Raleigh grow too. So,
Okay.
but yeah, we're doing totally Raleigh. So.
All right, y'all ready?
And then that's, my banner is actually behind you, so I do have a QR code, so if you want to scan that, that'll, give you all my contact information.
The one from earlier, it took me to a Facebook link. Is there any other way to get it? 'Cause I don't, neither one of us have Facebook.
We're on YouTube as well.
YouTube.
Yep.
Okay, you don't want to got this thing.
Oh, yeah. I forgot I was live,
Trying to be fancy.
I've been carrying it around in there. I've been missing it at home, so why not use it? All right, so let's get started. I set my timer. All right, step 6. You want to talk about step 6?
Oh, so home inspection. Choosing a home inspection company. So most of us as realtors have those go-tos that we like to use, and a lot of times we pick them up from clients that decide they want to use them, and we just kind of keep them because they do a thorough job. I know the guy that I am a big fan of, he still walks roofs. So he's using that ladder to get up there and walk the roof. A lot of home inspectors use the drones. But for me, I'm thinking, if it was my house, would I want somebody to walk on it and be able to feel the soft spots, or do I want somebody to take pictures over it and then try to guess? But you do have that home inspection. It is a visual inspection, so they can't go into the walls. They can't take apart anything to find out. They will check the AC or your heat to verify if it's working. And this is all based off of at the time of your inspection. So we know how houses work, just like almost like cars do. Just because we check something and it's working today doesn't mean it's going to be working in a month. So once you do the home inspection, the home inspector will go back through and let you know everything that's wrong with it. I tell people, don't be scared. If you just handed him $600 to find everything wrong with the house, he should find as much as he can. So you might have a little booklet, and it usually is about 40 pages, depending on the age of the house. And the cost of the home inspection is typically based off of the age and the size. So they can run from $350 up to $800, depending on what all you have to do. And your home inspection is just the house itself. If you are on a septic and will and all those things, those are separate inspections and separate costs for the buyer. Okay. Most home inspections now are getting a little tech savvy, where they are able to highlight what needs to be repaired. You can ask questions during those sessions. So I tell people, go to your home inspection. I normally ask my clients to show up right towards the end, so we can give that home inspector time to go through the house without us bothering him. But typically they're very good at telling you how the mechanics of the house work. You know, if you're asking about filters, especially if you're a first-time home buyer and never owned a home, you want to find out where the water cutoff is and those type of things. And they're more than willing to help you through those things. Yep. Yes.
From you guys' experience, like you were saying, walking on the roof, like I would definitely want, someone like that. But is that like common, or is it just like Uncle Leroy? You know what I mean? They did that all their life. He always checked and worked on everything in the house. So that's just what
We're recommending certified home inspectors, but I do have clients that will push to have their friends or the people that they know, because they're contractors or whatever, to come in. I can't stop you from doing that because it's your choice and we can't steer you. So if you decide that you want to do it, because I have people that will work for the city and say, hey, I have my friend that does this. And on a recent inspection I did with someone, and they said, no, I'd have somebody. And literally they couldn't come. So it was me and the home inspector. We were there for 25 minutes.
25
minutes.
It's usually about a 2-hour inspection, or more. And we usually recommend that you come like the last 30 minutes for a summary after that inspection. 25 minutes. You can't even test the dishwasher in 25 minutes.
That's all I'm gonna say.
Wow. Yes.
Like I would rather like buy a newer home, but just in case something happens that I have to get an older model. Do they inspect like if they have termites and stuff? Because I know you really can't see that.
So that's one of those other inspections you can have that is a cost to you. So you can do termite, you can do radon, you can do your well and septic, you can do water testing, you can do HVAC inspections. There's a list, any part of that house, there's a specific inspector that will come out and look at it for you.
And VA,
Go ahead. No, go ahead.
VA requires a termite inspection. So if you get a VA loan, you got to get a termite inspection.
And all the other inspections we said, they're not required. So your lender's not going to require that you do any of them. But if you want to know, I would rather know up front and be able to walk away from $5,000 than get in the house later and I have $50,000 worth of stuff that I need to fix.
So USDA, do they still require a septic as well? USDA?
So septic, so there's an inspection your well can only be within a certain number of feet from your septic, things like that. So there are still specific things that, they do require.
Why?
I don't know. Don't ask me. No, I'm just going fast. Sorry.
Oh, okay, go on. Okay.
Okay, which way we at?
Seven.
Okay.
Are we streaming?
Yes.
Mhm.
Oh, okay. Do you have a link in there? 'Cause I don't see it.
So the appraisal, we already talked about this earlier. The purpose the purpose of the appraisal is to check the value of the home. As a real estate agent, we're gonna pull comps, but we are not allowed to put value on the property. Again, the appraiser, they're gonna go in, they're gonna check the property, they're gonna pull the comps based on the condition of the property, the size, and the design of the property. So if it's a 2-story home and you have a ranch, they're gonna look for ranch properties. They're not gonna do 2 stories. Sometimes they will.
If we can't find
If
anything
they can't
else,
find anything else, but they're gonna try to find the comps as close to that property as possible. You're not gonna do a manufactured home and a stick-built home, if possible. Okay. Also, if the property doesn't appraise, this is why it's important, y'all. I know 2020 market, everybody wanted to go in and they wanted to bid their full pre-approval amount, but the pre-approval amount is 400,000. The house is only worth 300,000. The bank isn't gonna approve you for that. So whenever you go in, you want to make sure that the comps make sense, because if you overbid and the seller decides that they are not going to come down on that price, you're going to have to come out of pocket or you're going to have to back out because the bank isn't going to approve it. Okay. So that's why it's important to make sure you are having comps pulled before you make an offer.
Yeah.
Your agent should do it. They don't ask.
yes.
Okay.
And that is a big thing because
Put it on mute, Erica.
because one thing about I don't like to hear myself talk.
I'm sorry, y'all. Hold on, Erica. I'll mute you, honey.
I got it.
You got it? Okay.
So I muted myself.
All right.
Okay. I was just going to say, because whatever our contract price is, that's what you're telling them that you're going to pay. So you're bound by that contract that's what you're going to pay. So if you offer 300,000, the house appraises for 275, that means we have a deficiency of that $25,000. We need to figure out who's going to come up with it. And a lot of times the sellers will come, will maybe meet you in the middle, or we do some creative stuff to fill in that gap. But understand that bank is only loaning you the 275. So that's where we kind of got in trouble. And I think that's where a lot of people are starting to now have that kind of buyer's remorse because they feel like they overpaid. But houses are worth what you are willing to pay for.
Boom. Yes. And the appraisal is only good for 24 hours, for one day. So tomorrow that house could be worth 200,000. So it just depends on the market. All right. Are we making you guys excited about buying a home?
Or scared.
Terrified. Change your mind. Clear close.
I mean, at this point, it's just like rents, they're the same prices, getting a house or mortgage, so.
Well, and for a lot of people, I tell them, as far as you have to remember when you are renting, and buying a house is not for everybody.
Right.
However, I would say when you are renting, keep in mind that you're going to pay this, whether it's the same as a mortgage payment or not. But when you get ready to leave this space in 5 years, if you're renting, the most you can hope to get back is your security deposit. And then that's a maybe. But, when you own a home, then you can get back, whatever your equity is, or, any of those type of things. So for a lot of people, it makes sense.
So before we talk about clear to close, right? Because this is a great thing. I
Those
do
are your
want to
favorite words.
Yes, I want to rewind all the way back to you getting pre-approved. Once you're pre-approved, you don't want to go out and add anything to your credit. We talked about this just a little bit. You don't want to add anything because that could affect your DTI, your debt to income ratio. You don't want to change jobs. You don't want to change bank accounts. You don't want to change anything. Am I missing something?
No.
Please
That's basically
don't quit your job.
Definitely don't quit your job.
Yeah.
I've had that happen.
Don't decide you don't want to get the same overtime you were getting. And the reason we're saying that is because the lender is going to check your stuff all the way up until the day of closing.
Right.
We've seen people, they want to change their jobs, they want to quit their job, they want to pull up on closing day in a new car. Don't do that. they want to buy their furniture for their house that they don't have.
Mhm.
Then
Yeah.
on closing day, everything just fall through.
And then don't change your, like, the way that you get paid. I had one person who, they were a W-2 employee, and 2 weeks before closing, they switched to a 1099. Even though they were doing the exact same job, but then that jeopardized their loan, because it's like, now you are self-employed. So now that's gonna be different. So it's almost like they quit their job. So definitely, throughout this process, if you have any questions, if you are thinking about doing anything, then this is when you wanna call me, you wanna text me. My cell phone number is what's on my card. So you can always get me, anytime anybody wants to check your credit. So I had one person where, when I tell you, she called me for everything. If it was like, hey, the utilities, want to check my credit, is that okay? Yes, that's fine. But, check in. But I've also had a person, like she said about the furniture, a person who went out and bought furniture on credit. Once we got the clear to close, but that loan was not closed. She couldn't close on her loan.
So what clear to close is what, Erica? What does that mean? Like, if we are excited about clear to close, what does that mean?
So that means that we have looked at your whole we've looked at everything.
Mhm.
You've gone through underwriting. Underwriting has approved, all the pieces of your loan. So as long as everything remains the same, you are clear to close on this house.
Your appraisal has gone through.
Right. As far as we're concerned, we're willing to loan you this money.
So yeah, and you usually get that about 3 days before closing. It means your contingencies are completed. Your cost to close is there. Your closing statement, the lender, they're going to send you your closing statement. That's when you're going to find out how much you need to bring to closing. Sometimes you're going to get a check. Sometimes you may not get a check. You may have to bring a check. But this is where you're going to know, okay, do I have this money for closing? Can I bring this to closing? So just make sure you review your closing statement. We're going to schedule your final walkthrough, which is usually the day before or the day of closing. And then we're also going to bring you to the closing table. Y'all, this is Nikki, right? She is the Charlotte Realtor of the Home Buyers Clubhouse. So, yeah, and then we're going to go to the closing table. All right, so we are at the final steps. Let's talk about closing costs, Erica.
So these are your the items that's included in your closing costs. So you're going to have things like your property appraisal, your home inspection. Again, that's not something that you have to have. It is highly recommended. Your processing fees, your underwriting fees, lending fees. Usually your home inspection is not included in the closing costs that I give you, because it's optional. That's something that will be outside of the figure that I give you for closing costs. Your loan discount fees, and what that is if you are paying us to get a lower rate. So that's what a loan discount fee is. Recording fees, so your loan has to be your title information, the fact that you bought this house, all of that has to be recorded. Any settlement officer fees, your title insurance, document prep fees, and then your escrow, which is your taxes and insurance, which is included as part of your loan.
I think over the break I heard someone say, what about zero down? Zero down, but this is where all the extra money comes in. So this is where you have to be prepared. This is what you have to be prepared to pay out of pocket.
Right. So zero down does not mean no money, that you don't have to come out of pocket. That just means that you don't have to pay a down payment, but you still have to pay closing costs.
There we go. So about 3 hours ago, we were talking about your closing cost breakdown. We moved it after the closing cost. Makes sense. It does. So if you purchase a home for $400,000, your due diligence deposit is about 1%. That's about $4,000. Your earnest money is about 1%, which is another $4,000. Your inspections, your property, termite, radon inspections are about $800. Your appraisal is around $500. All right. So that's your $9,300 that we talked about earlier. And then let's say if you have an FHA loan, which is about 3% down. Everyone may not have that.
3.5% for FHA.
Yeah, 3.5% down, which is about $14,000. But you're going to subtract your $8,000 deposit that you have right there, your due diligence and your earnest money. And then, what's the 6,000? I can't see. Oh, your 6,000. What is the 6,000? Let me read from here because I can't see.
That's the difference between the 8 and the
So
4.
yeah, so you subtract your $8,000 and then you owe about $6,000 at closing. So there we go. Can't see from the side.
No.
Any questions about that? Because usually everybody's just like, oh my God.
This is it's like a general knowledge.
Yes, it's
very
generalized.
general. So
Because actually her total is 15,300 because we're totaling your 9,000, doing all your subtraction plus your 6,000, and then you're going to come up with 15,300 at closing if you didn't have any down payment assistance or anything like that.
So all of that up top, the 9,300 is what we just went over, the closing cost breakdown.
Mhm.
Yeah.
And then if you had a 0% down payment, you technically wouldn't have to do that 14,000, so it would
got
just be 9,300.
Yes.
Okay.
Yes. So that's just your out-of-pocket expenses up front, your 1%. And again, you don't have to do the 1% due diligence or the 1% earnest money. You don't. But
you have to do a due diligence and an earnest money deposit, but it may not be 1%.
You
Technically, you don't have to.
Yeah.
If we get in a good market, we
Yeah.
were doing it without it. But these days, I think we're far removed from those times.
yeah, you don't have to, but it shows the sellers that you're serious.
Yeah.
They're not required, but you're showing them like, I'm not wasting your time. Again, engagement ring, like put a ring on it. That's what you're doing.
And sometimes you can find those. She said,
Listen, I got that.
I caught it, girl. I caught it.
we won't say anything. Every now and then you can find a unicorn, and those are the houses where maybe the seller has had their house and it fell out a couple of times. So it's been on the market for about 30 to 60 days. It's been under contract twice. Now they're on the third time and you're looking at it. So you may be able to negotiate your fees down so that you're not putting yourself at so much risk. One of the things that we were looking at during the time when we were at a height of the market is if it didn't appraise, we were writing in things. Some people were waiving that appraisal gap that we were talking about, but a lot of times we were writing in or having an addendum that said, hey, if it doesn't appraise, we want our money back. If you're not willing to negotiate with us, then we want this money back. Now, all sellers will accept it, but you can always try it.
Okay. Any questions?
So for the new construction, like I was
Mhm.
asking about
Mhm.
earlier, where does this due diligence or earnest money deposit comes in?
Well,
That's concerned.
it depends on the builder because the builders, they're trying to get creative. In the old market, they were, some builders, they're now offering incentives, but I just did a new construction the other day. They needed a $10,000 earnest money deposit.
Yes. So I think the days of new construction being us giving $1,000 and going under contract pretty much are gone because the height of the market took it so high. That what we're seeing now is most builders want anywhere from about 2% up to about 5% in my way for you to be able to go under contract, which means that new construction not all the time is affordable.
Yeah, but they are,
They
outside
are
of
getting
that, they're giving away $10,000 incentives towards your closing costs or use it as you want it to go to the design center or whatever you want to do. But some may require a higher earnest money or deposit upfront. Ask before you go.
And know what, with new construction, know the reasons why you can get, if you have to walk away from it, because not all builders are the same. Some of them, once they lock you in and you sign that check, they don't care what your reason for terminating is, your money stays with them. So you need to know those things up front. And I think the trend right now is incentive for buy down rates because the rates are higher than what we had gotten accustomed to. So you can use whatever incentive money that they give you to be able to buy down your rates and bring your payment down to make it more affordable for you.
Yes. Lower rates, lower payments. Any questions?
So if they give you this $10,000 incentive because they're charging 2%, 5%, whatever for the earnest, that can go towards this closing, it can go towards anything, but your earnest money is still there as well, right? That never vanishes, it still goes to your closing.
Yep.
Okay. Is that good?
In a way, it depends on the builder because
Okay.
it depends on the builder. Let me hold on. Okay, so it depends on the builder.
Okay.
Okay, let's say that. Some builders, they say they're gonna close in 3 months, they close a year later. Just had to happen. But some builders, they say they're gonna close in 3 months, they close in 3 months, maybe 4. It just depends. And then if you want to back out, you can't get that money back. In some cases, it just depends on how they have it typed up. But 90% of the time, the builders have this contract to benefit them.
Because
Not
you are,
you.
yes, because you are using the builder's contract, unless they're like a small company and they are using our contract, which is more towards the buyer. Well, most of it. But the builder contracts, they're designed and were written by their attorneys for them.
Lord.
And that's how a lot of times when we're in the height of COVID, you could get to closing and then they could tell you that the cost of their house went up $50,000 and your only option was to back out.
Right. Yep.
They keep the diligence and the earnest.
Mhm.
And a lot of times we were seeing the builders refund your money because guess what? I can give you back your $5,000 to $10,000 because your house just went up $50,000 and somebody's gonna buy it.
Yeah, with COVID, the supplies, they were delayed. The windows were not coming in, so everything was just at snail pace. So
And it was taking us longer to build. Oh,
mhm,
Jesus.
it was terrible.
Mm.
But it's better now because we have more supply and the demand is lower. So yeah, supply and demand, supply and demand.
But I think that's probably gonna change. I feel like that's gonna change, like, as, the spring comes in, because you're gonna have more and more people. Right now, you have, 500 people looking for a house, but there's only 100 houses available.
Yeah, and it is changing. I've seen multiple offer situations with my seller clients. So it's changing. Houses on the market, you're receiving multiple offers, but if you look at the numbers, they started dropping around November, between October and November, October and December, let's just say. The numbers started dropping, but right now in January, the numbers are going back up. The average days on the market went up, but they're dropping right now. They were at like 150 days. I've seen sellers reduce their prices at about $80,000. But now the market is going up, so the number of days on the market, they are a little bit less.
And remember, it's specific to areas. So what I'm experiencing in Greensboro may not be what's going on in her Raleigh market or here in Charlotte. So I can tell you what we're seeing is houses are sitting longer in certain pockets, but it's because our buyers are a little bit more savvy now. You've heard the horror stories. Your friend went through all of this and they gave up $50,000 and now they're in the house and they have their issues. So buyers are not buying the houses as quickly as they were before. And they're being real conscious on what they're buying. So they're walking in and they don't want your house if you hadn't fixed it up. They don't want that house that is not HGTV ready and give you full price or over asking. So now those houses are sitting longer. But if you put your house on the market now and it looks good, it smells good, and it looks like you've taken care of it, you could get 20 offers still.
Yes.
Easy.
But in the slower markets, I have good news for you. You can get something that's called seller paid closing costs. So all of this extra money right here, the sellers, they can give you up to a certain amount, depending on the loan type, and seller paid closing costs. So it just depends on the market.
And one thing I was going to say, because I've heard a lot of you talk about new construction, understand that because of all the things that were going on during COVID, our builders could not keep up with the supply. So if you're ready to move right now, new construction may be something to think about if you can afford to do it, because guess what? They're just now starting to catch up. So they got inventory sitting. So they're reducing prices. They're offering bigger incentives. They're willing to work with you a little bit more. And depending on the builder, they even, I know like True Homes in our area has a line that's a little bit more affordable than what they were building before. So now, even though I'm saying you might need 2 to 5% for your earnest money for your builders, a lot of them are breaking it down into payments if you need it.
So they're working with you. And you're right. Yep.
Because their inventory is,
Yep.
And if you can find an inventory home that's been sitting, you probably can really cash in really nicely.
Indeed. Any questions? Nothing? Y'all good? All right. Dun, dun, dun. Come on now, wake up. Wake up. There you go. It's closing day. We made it, y'all. We made it. on closing day, make sure, Erica, tell them what they need to make sure they do on closing day, especially when it comes to spouses and the people that's on the loan. And all that.
Anybody that is going to be on the title needs to be present. So if, just like if you have a couple and the loan is in the wife's name, the husband still has to come in order to be able to sign. You need to make sure that you bring your ID. You also need to make sure that your any monies that are due has been wired to the attorney's office.
And that's a good place for us to bring in, if a lot of times as realtors, we're not giving you wire full information. Your information for your wires.
Mhm.
That comes directly from the attorney's office. So we're not going to send you that information because there is a thing about people hacking emails and doing wire fraud. We don't want you to be a subject of wire fraud.
Mhm.
So make sure that you verify where the email came from in case you do have to send that money, and call and talk to the attorney's office directly. It became big where people were losing hundreds of thousands of dollars because they ended up wiring it into the wrong accounts. Once it goes, it's gone.
And I will say, as a lender, we also do not provide that information.
No, we don't.
You have to get that from the attorney. And again, like she said, I recommend calling the attorney's office from the information that we will give you. As far as like within your process, there will be a phone number. So don't call the number that's on that email that you get the day before closing, because you want to make sure that that is the attorney's office number, because we've had somebody lose $30,000 because they wired it to the wrong place.
And I think I've heard stories of upwards of $300,000. I know there's a lady out of Greensboro that lost about $300,000.
And do you guys choose the lawyers for us, or do they just like, there are certain ones that you work with that we just work with because that's who you choose, or how does that work?
You can choose your own.
Okay.
You can choose your own. We
But-
have suggestions.
If you don't have one, we usually say, hey, look, this is the one we've been using for.
Okay.
But you want to make sure that you do choose a real estate attorney, because
Okay.
there are some people that are like, hey, my friend is an attorney, and they may be an attorney, but they may not be a real estate attorney.
Right, okay.
We just sigh deeply.
Yes. It's like if your friend is a traffic lawyer, that's not gonna help you.
So yeah, go Nicole. That just
So-
took me back to about
so-
last week.
As realtors, what we can do for you is help you visualize your dreams, as far as helping you with estate planning strategy sessions. So your realtor is a wealth of knowledge. Your lender is a wealth of knowledge. So we help just not in with opening doors and things like that. We help you with your financial goals and things like that. And if we don't know, we should be able to point you in the right direction. Matching your price range and making sure we stay within budget, building wealth and legacy. One of the things about real estate and why we're so passionate is we know for a lot of people that look like us, this is the way we come into wealth. This is the way we start our wealth building, through purchasing homes. It's amazing how people that bought during 2005 through 2006 that could keep their houses, we were underwater for years. And for us to be able to buy a house for 160, and in the last 2 years be able to sell it for 300,000, we had more cash in hand than we've ever had. You don't usually have that kind of return on investment with anything else that you do. So that's why even if you're renting and your mortgage payment looks the same as your rent, you can't do that with renting. You can't walk away from your rental apartment unless you sue them and get good money, to be able to say, you know what, I stayed there for 5 years and I just made $70,000. That's when it was really awesome to see some of my clients that stayed in their homes and sold them within the last couple of years and walk away with a check for $130,000. Yeah.
Yes. Any questions?
And sometimes that helps you towards your next house.
Absolutely.
Or if you started with your starter house, but you want a bigger house because your needs have changed, then now it's time I can sell this house and get money to go towards my next house. Things like that.
And a lot of
You could do what I did and rent your house out
Yeah.
and flat equity and get money.
Right.
So, and one of the things I don't lost my train of thought. What was I going to say? Oh, no, you're fine. You're fine. One of the things that we hear a lot of people say is the interest rates are higher or the houses, we're overpaying for houses. You're not really overpaying for the house. Because if you think about it, you may be selling your house and you just made $120,000 off of that house. If we go back to the other slide, are you going to use that $120,000 on that house as a down payment? Most of us are not. So you're putting down your typical down payments and those type of things or whatever you need to go towards your house. And you still should have money left over. That's when you really made a great investment. And that's why real estate is one of the things that almost any celebrity or whoever you talk to has something to do with real estate. They're dabbling a little bit into it.
Mm-hmm. All right, we're almost done. Then we're gonna move over to credit. All right, I think we are done. So yeah, we're moving over to credit. Y'all don't have any more questions while we switch over? Should we take a break? We're gonna be here for about 30 minutes now.
I have a question just about her comment with new buyer or new builds. Say you move out in like 5 years from your new builds, can you rent those out, or is there any stipulations with it being like a new build to like
Nope.
rent?
You probably just need to make sure that it's not an HOA thing. We're starting to see more of that. But other than that, you should be fine.
Okay.
And as far as the lenders are concerned, usually you have to stay in a house for a certain length of time, but also it depends on some of the programs that you may be using. So just like a lot of down payment assistance programs, they do require that you have to live in this house as your primary residence for XYZ amount of time. And it differs depending on programs. There are some programs you have to live in this house for 36 months. There are some programs that this has to be your primary residence for 15 years before you don't have to pay this money back.
Oh, I can't use your laptop. I'm gonna use Erica's laptop. All right, we're gonna call the break, y'all. Call a quick break, and we're gonna get this set up. We're gonna need to use your laptop.
Okay.
I think
Yeah, we still have 28 minutes left.
That's because we didn't cut it right at the right
Yeah, we
place.
usually cut it.
Mhm.
Credit.
And we're doing
The credit. This one. Just go to your email and then pull it up, and then it'll be this one. And then we can just kind of slide this one over. If it dies, I just be out
I
of
was gonna
the.
say I have I've got my cord because I think I'm good.
What I'm gonna do is I'm gonna slide out this way.
Or we can just go on and do. I'm sorry. Yeah, you can slide down. We can go on and do it until mine get ready. And we take about 30 minutes. Mine should survive for another 30 minutes. I'm just going to go through.
I'm looking for, what is it? Home buyer workshop. Okay.
All right. So, all right. Y'all don't need to take a break. We can keep going.
Y'all gonna come closer to each other?
Yeah, I think she. Yeah, no, we can swap it. You slide it down. It's in hello. Yeah. I had it up. We usually take a break right before we start credit. I had plans to do that. Yeah. Oh, but you need to.
You send it back to me?
Till day after? One-on-ones?
Yes, you got it? Erica, she'll have a few questions. She should do it.
Okay.
Yeah, you can, I just was saying. Yeah, I just don't want us to have to switch out and we're gonna have to switch out some.
Okay.
Where's she at? Erica don't know how to search. She's scrolling through. What in the world, girl? I am so confused. Yeah, I'll let her pull this up when she get back, cause. All right, I'm gonna go ahead. I just don't wanna have to switch out in the middle of it. And Erica, I'm done. Did I see your baby pull up?
She probably, no, I'm sure she in the car sleep. And she working third shift, so she don't last.
Oh, well, she got that good. I don't think that's her.
You need me to resend it?
No, that's something else. That ain't her. I'm not on her emails and stuff. That ain't even it. Eric, can you go to the top of your email? That ain't it.
We didn't talk about email. So let's get more of that.
I just sent it to you. Do it again.
Outbox. There it
You
is.
just came through. Okay, good. All right, let's switch now. What? I unmuted myself. You got it?
It's working. It's pulling up right now.
I can't figure out how to get back to stream though. It's there, but I just muted it. All right. Are you charged?
Mhm.
So I charge him like what? No. You got 10 windows open. You must have a good laptop. My laptop. Present. All right, so since y'all didn't want a break, turn it down.
I don't know where we coming from.
Hold on, Erica. How you
There
how you take
this?
no, that ain't it. Because they can see everything.
Okay, you just had it on there.
No, I gotta be able to present with the notes. See, they can see which is duplicated. How do you take it off to F8? PC screen only. That ain't it. It's extended.
You want to project. You want to project your PC screen.
No, because they seeing the same thing I'm seeing. This is right here. This is it.
Okay.
So where is it? So you got 1,000 windows open.
Where's what, the StreamYard?
No, where's the no, not StreamYard. Where's the slide deck? Okay, so let's escape that and slide that over. All right, let's try it again and present it. It shouldn't be like that though. Should be able to present it, and then we have our notes and stuff up.
How do I want this?
Okay, you got 1,000 windows open.
We'll close them.
I don't know how. Let's see. Hold on.
So you got it on extended, here it is. We want to do second screen only.
But no, because I need this screen.
It should have some.
Okay. We'll just slide through.
Let's see.
You don't have a slideshow button. There you go.
Yeah, but you
And
put
hit
it
your
on.
slideshow.
Hold on, it took me out. Because I can't see. All right, let's do that. Okay, now you slide this over there, wherever it is, Erica.
Just get it quick. So here, so you can
It's like
get
10
just
minutes.
this one.
10 minutes up yet.
So you just got that one.
It's fine. Just put it back up. We'll get through it. Just put it back up. We'll just click through it. Start here. Let's see. Hold on. Let me.
This screen.
Hold on. So we did wrong this time. Yeah.
I need to do it. It's up there.
All right. We're just gonna do it this way. I just have to look inside of this. All right. Sorry about that, y'all. Let's just hit present and get through it. All right. So let's introduce ourselves. This is your step-by-step credit guide. This is going to definitely take some time. Make sure we set our timer for our break because you're going to need your break, although we started 30 minutes early this time. For me, I am a wife, a mom. I've been in real estate since 2015. I became a board certified specialist in 2015 as well because I discovered whenever getting into real estate, I discovered that a lot of people, they needed help with their credit. Of course, you got to have at least a 580 credit score. So that's why I became a board certified credit specialist. Nicole, oops. Sorry for putting this.
So I am a wife and a mom, and I do have a 3-year-old grandbaby. I've been in real estate, even though that says 2018, I actually got my license in 2008. So I've been at this for a long time. I am not board certified with the real estate, with the credit, but I teach from a lot of experience. I've been doing this a long time that I kind of stick my nose into everything because like Jesse, I realized that a lot of clients needed the credit help. And I started my journey the same way. When it was time for me to purchase a home, me and my husband, I learned that we were not credit ready. So we took some advice from somebody else and that wasn't right. So one of the things I was dead set on finding out is how to do it. And I was not going to pay a whole bunch of money on getting my credit cleaned up when I could do it myself.
Amen. You're trusting all the wrong people.
Mm-hmm.
All right. Erica, you want to introduce yourself? I know you've already
Sure.
talked about that,
Well, I'm Erica Batts. I'm your mortgage loan officer. I have been doing mortgages for 7 years now. I originally started off at a credit union, and then I came to a mortgage company, and I'm passionate about helping people become homeowners. Just because I know that that's for a lot of us, that is our journey to build wealth, things like that, and that's the way that we can set up others, whether it's your children, whether it's other people in your community, in order to be more successful. Because I know you have a lot more leverage once you own land.
So we want to open the floor because we know we've had our credit struggles. So we want to let you know we're not judging you here. I've had repo, I've had foreclosure, I've had all of that just because I listened to someone else. Somebody told me that, okay, Jesse, you can get this car or whatever. You just call them, tell them come pick it up. It won't even be a repo. It won't even hurt your credit, you know. Same thing. I was selling my house. I was pregnant. I moved. I was selling my house. The realtor that was listing my property at the time, he called me. He said, Jesse, someone just broke out all your windows. They vandalized my house. Like, never had any issues there. They broke out my windows. They stole my AC. They vandalized the entire house. So that's how I ended up with the foreclosure. Again, same thing. They said, well, it's a deed in lieu foreclosure. So it wouldn't really hurt you or whatever. Okay, cool. Cause I can't fix it. You know, I'm paying rent right now. So it's just basically, I've been there. Now, of course, I'm a homeowner. I have a house. I have people calling me to get credit. I have people calling me to do different things. And that's where you want to be in your life as well, whenever you get your credit, wherever you need it to be. Nicole?
I guess the biggest thing besides the credit thing is that what I've learned through my journey, because if you realize I said I got my license in 2008. Well, during that time, I got my license at the end of 2007. I went full-time through 2008, not by choice, but both by force, because I lost my job. So it created a definite struggle with me and my husband paying mortgage payments. And we had at the time, you remember, they were giving out those 80/20s mortgages, and we were seeing the ARMs, which they don't really do a lot of the ones we had. But to see your mortgage payment go from $980 to within 6 months, my mortgage payment was $1,800 a month. So it put us in a little bit of a nasty place. So we had to decide, whether we're going to feed the kids or we're going to pay the mortgage. So one of the things that I learned over the times is I specialize in short sales and pretty much helping people prevent foreclosure on their homes. That came from my journey. That came from being in foreclosure, not only because the mortgage payment went up, but I was starting a new career at that time and real estate wasn't moving as fast. So my house has hit foreclosure a couple of times, and by the grace of God, I've been able to keep my home. So it taught me a whole lot of things on how to teach other people how to keep from putting your keys on the counter and just walking away from it. Because a lot of people did that. And it was amazing at how many people would walk away from their homes instead of fighting for it. Mm-hmm. And there is so many resources out there to help you keep it. But if you're renting, they give you 30 days and you're being evicted. And with the banks, they don't want it back. So a lot of times, even with COVID, we've seen banks doing defers and all kinds of things, and all kinds of programs came out of that to keep people in their homes as long as they could.
I thank you both for sharing your stories. That is beautiful, and I'm really grateful because we all have them.
Absolutely.
Mm-hmm. My thing right now, I hear a lot of bad credit. That's not the problem. It's the money.
It's the money.
How do you come up with, I am a single parent person. I'm going to do it by myself. I don't have $10,000. I don't have $5,000. I'm barely making my $1,400 rent. So can y'all shed some light on where is the money coming from?
So the part about with COVID brought more money into this market than we've ever seen. Mm-hmm. But what a lot of people are doing is when we say money, there's sources that you can get. If you have somebody that can gift you the money to do your down payment, if you can pull it from your 401k, a lot of people do that. Mm-hmm. So there are places where you can, and just because somebody says no, there's always a different way to move it. Sometimes it may not be our time. But typically, there are programs out there, whether it be your state or your city, that can do down payment assistance. I know in Greensboro, the city of Greensboro just rolled out a down payment assistance program that doesn't have the credit score requirement that the state does. And it will give you up to, I think it's $10,000, $15,000. But there's some other little catches that goes with it. So it depends on the person of what will work. So if you're one that, especially if you're going to use those type programs for new construction, they work better because you don't have all the inspections like you would with an older home.
Yeah, and in the Home Buyers Clubhouse, we know that that's a struggle for a lot of our buyers. So we are always talking about, different ways to earn money, like getting side hustles and different ideas on how you can gain. I know one time we were heavy on stocks, although we don't know a lot about stocks, but we saw us earn some money with stocks.
Right.
And at the time, it was like penny stocks during COVID, like investing $20 and that turned into $1,000. It's just, we can't give you any advice on it, but these are the ways we've learned how to earn money. Miss Nicole, well, never mind, you got to get a house first.
Well, and then just like with your down payment assistance programs, things like that, those programs are out there. But like you said, you still need some sort of money.
Mhm.
But there are some, in some pockets, then you've seen, okay, seller paid closing costs, plus this down payment assistance program or whatever is like, okay, so you're coming to the table with $1,500.
Mhm.
Whereas, but again, that's going to vary. It's going to depend on the market, and it depends on what loan type that you're working with. Like FHA requires there be 3.5% of your own funds from, whatever source. So
I had a client, she saved about $20,000 just from her side hustle as well. She was on it, she sell things on Etsy. I mean, a QR code, different things, $20,000 down. So it's possible. It's just whatever you like and whatever you feel like you're good at, you're comfortable with. If it's just Ubering or DoorDash or different things like that, there are side hustles that you can definitely save this way. Yeah.
and then right now it's tax time. So you get a lot of people saving funds through, their tax refunds, things like that.
And I will say this, even though as realtors, we don't like to hear it, challenge your realtor. If there is a program out there or you're having problems with finding funds, have them to go find it, help you find it. Ask your lender about, are you qualifying for me, everything that's out there. Sometimes we have to dig a little bit, but there may be a solution that is not something that we like to do but as long as hey, that if we go through the city, that it's going to be this, this, and this, it may be a fit for you. Sometimes it's not, but it may be a fit for you. I know in our area, right now, we're stacking down payment assistance programs. So we're able to use the 8,000 with North Carolina on top of what the city of Greensboro has given us. And we're actually being able to qualify clients to be able to actually have $50,000 in down payment assistance help. So it just really depends on what's available in your area.
Okay. So let's get started. Let's get started. So we know why you're here. You're here to buy a house. We know. But you could just need a loan, or you just want more information. I remember when I was in high school, my only goal was to get an apartment, to have good credit. And then once I got out there, I realized that it's real out here in these streets. Mm-hmm. I didn't know what to do. I'm shopping at my mama's house for groceries. And it's like my phone's turned off, my cable's turned off, everything's turned off. So yeah, it's tough. So it's tough out here in these streets. So we know and we understand all of that. Let's go. Let's talk about taking charge of your credit. So let's get into it. Sorry, Eric, I'm trying to navigate your computer. All right. So taking charge of your credit. Good credit is critical. We know that. We know that good credit is important. Banks, they won't approve you. They won't give you a loan if you have a bad credit score. You have credit card companies out there that will reject you. Your insurance companies, they may charge you a higher rate. So we know that it's very important. And even whenever you get pre-approved, we know that you may end up with a higher interest rate as well. You also want to keep in mind that this isn't an overnight process. It's going to take some time. You guys say y'all don't have credit issues, right? Or do y'all? Let me see. It's going to take some time. It's not an overnight process. So just kind of keep in mind, and let's kind of get started. Erica, okay. I'll let you talk about understanding credit. If I can get to the screen.
So understanding your credit score. So these are kind of the categories as far as your credit. So, if you consider that 350 to 850 is the range of the scores. And so this kind of tells you about where you are within those ranges. 16% of the people have credit between 350 and 549. I will tell you, I feel like that number is higher. But that's what the chart says. But then you also have, people and I've had people say, oh, well, I have bad credit, but I have a 620. Well, that's not really bad credit. That's enough to be able to get you a loan, things like that. But because they don't have an 800 or an 850, they feel like, oh, well, my credit is bad. And that's not necessarily the case.
Oh, no, sorry. All right. See. So Erica.
So this is why it's important to have a good credit score and to know your credit score.
See,
So the 5 factors that determine your credit score, these are going to be, so when they're looking at your credit score, they want to know how likely are you to be able to be responsible with whatever this money is that we give you. So your first category is your payment history. So we look at, okay, how have you paid your debts? And basically credit is just basically saying, did you pay back what you said you were going to pay back in a timely fashion? So credit usage is how you use your credit, how much of your credit that you have used. Just because we give you $1,000, if you're constantly at that limit, then that's showing that you may not be able to use credit responsibly.
and we're gonna go deeper into this later. Your space part doesn't work.
Your credit mix, which is the types of credit that you have. So you have mortgage debt, installment debt, and revolving debt. Installment is when you have a fixed number of payments, like a car payment, a personal loan where you have 36 months to pay this money back, that type of thing. Whereas your revolving is, when you have that revolving amount, as long as so you pay back that $1,000, you still have you now have that $1,000 available to use.
So you're on credit mix, credit mix.
That was credit mix. So the age of accounts, how long have you had credit? And then credit applications, like how much credit have you applied for within this particular period of time? So, and this is your percentages of what those things count for. 30% of your FICO score is determined by how much you owe. 35% is your payment history. 10% is your new credit. 15% is the links of credit history. And the remaining 10% is the mix of credit that you have.
Okay. So we're going to talk about the different types of credit that you have.
So revolving credit, those are going to be things like your credit cards. Those are things where you have that particular amount. And like I said, as long as you pay that money back, then you now have that limit available to use.
And you're not required to pay the full amount.
Right. Charge cards are cards where you are required to pay the full amount on a monthly basis. So just like American Express is a good example of a charge card. So they have a particular card where I don't care what you charge, it does not have a limit on that particular card. It could be $35,000, but if you charge $35,000 this month, at the end of the month, they want their $35,000 in full. Installment credit, like I said, those are going to be things like where you have a set number of payments in order to be able to repay that debt. So that's going to be like your car payment where they say you have 72 months to pay this money. And so you don't get to pick what amount you pay each month like you do with a credit card.
Okay. Sorry, I'm struggling with this.
I was going to say, let me get the mouse. Hold on a
Yeah, I'm
second.
struggling. All right, so let's talk about some steps that you can take to raise your credit score. Number one is you want to make sure that you examine your credit report. The first step in repairing your credit is knowing exactly what's on there. Look, I'm going to let y'all know this is going to be very tough whenever you start looking at your credit score. It's a lot. Your credit report is going to be a long and painful process, but you definitely want to take your time and you want to examine it. You can't fix it if you don't know what's on there. That didn't work right there. Number two, you can get your free annual credit report at annualcreditreport.com. And earlier we talked about MyFICO. Your MyFICO that's for your mortgage. So if you want your numbers as far as your mortgage, go to myfico.com.
Now I will tell you on Credit Karma is great for monitoring your credit.
Yes.
It's just not great for obtaining your score. And when you look at the MyFICO, once you have decided whatever plan it is that you want, and I think they range from $20 to $40 on a monthly basis for the MyFICO, but they have a section that says mortgage scores. And so that will tell you exactly what your actual mortgage scores are.
Okay, and just know that there are 3 different credit bureaus. You have Equifax, you have Experian, and TransUnion. So as a realtor, if we ask you what's your credit score, we're expecting, well, we say, do you know your credit score? And a lot of times people just give us one score, but there are 3. And again, the lender, they're going to choose your middle score, not your highest, not your lowest. They're choosing your middle score. So just kind of keep that in mind. Your credit score, it could be different at all 3 bureaus. And you also want to order your 3-in-1 credit report from any of the 3 bureaus because there could be a difference. So this is why it's important that you look at all 3 of them. And once you've looked at your credit report, again, you want to look at it closely and go through it. On your credit report, you're going to see personal things like your social security number. You're going to see your birthday, your addresses, your credit information, your open accounts, your closed accounts, your creditor's name, your original loan amount, your payment history, your credit limits, the amounts owed, and more. And you also can find public records on there as well.
And just like your name, or if you've changed your name, or any aliases that you may have used in the past, those type of things are also on there.
Yes. So again, as you go through your report, you want to look at the following information. You want to check it for errors. Are there any accounts that don't actually belong to you? Are there late payments on your account? Were they actually late? And you need to make a record of these for later. And we're going to talk about why you need to check this, okay? And we're going to teach you how to actually set up a system for it. You're going to check for past due accounts. These include payments that are late and accounts that have been charged off or handed over to collections. You want to add something to that? I know y'all usually have nothing to add.
No.
Okay. Number 3 is your current credit accounts. Your current credit accounts, I mean, it's just basically you want to make sure that you're looking for any accounts that's currently over limit or at its maximum. You're also going to approach each situation differently. This is the important part. For each one, for your past due accounts, your current accounts, any errors, you want to get a highlighter. And you want to take a highlighter and highlight them in different colors. And then that way, as you start going through your credit report, you will know, like, okay, I need to work on this first. I need to work on this. I need to work on this. I need to work on this. Any questions so far? No? Okay. Oh, I thought I saw a hand. All right. So reading your credit report for the first time, again, it's going to be overwhelming, but just take your time and just focus on highlighting each item for now. And then if you're feeling like this, just remember you're only going to take this step one time. This is the longest step. It's going to take about 30 minutes to do this. But if you are working on your credit and you're disputing your credit each month, it shouldn't take you no more than about 10 minutes. You can write the letters yourself, or you can put them on like a spreadsheet and print them out and do it however you want to do it. But this right here is the most important step. All right, Erica, you up.
Disputing your errors. The important part here is you can do your credit disputes through online, by phone, or through mail. I usually recommend either online or mail because you want to have a record of, what that you have disputed this. So therefore you can figure out, whether these accounts belong to you. Like I have a lot of times, especially like juniors and seniors, like where those things will get mixed up on a credit report. So we're looking for, or somebody may make a mistake on your credit report. It could be a collection agency incorrectly reporting information. You find that a lot, especially with like medical debts, things like that, like your copay that you paid to, such and such person, they didn't collect it or whatever it is, and then they'll put it on your credit report. So, or if your identity has been stolen, a lot of times that's where you find out that, okay, there's all these cards, because your name is Mary Smith, then that record has gotten combined with maybe somebody else. So those are things that you would look at there. And so how to dispute these errors. So filing by mail, like I said, that does have some advantages. You can be able to see when they receive the dispute because they only have a certain number of days to address this dispute before they have to take it off of your credit report.
And definitely, whenever you do it, make sure you make copies of everything. You want to make copies. Again, I say put it on a spreadsheet as well, so that way you know when to follow up. You have about 30 to 45 days to follow up. Well, they have about 30 to 45 days to respond to you. So definitely just keep track of it. You're not required to do them certified, but you could. You don't have to type them up. I wrote mine on a piece of paper and sent mine in. Like, piece of paper, like, didn't even have lines on it. I just wrote it on there and the date, but it doesn't matter. And then that way, because what a lot of people do is they're using these credit repair agencies, and what's happening is those things are getting flagged. They're using templates, and you're getting flagged. Yours is on a piece of paper, is handwritten. You're not gonna get a flag. They know it's nothing crazy going on here. This is a real person that's asking to have this fixed. Does that make sense? Okay. Sorry, Erica. Go on.
So what? When you file your credit dispute, be sure to include the information, which is a copy of your report, and highlight whatever the disputed item is, and proof that supports your claim. So if you said, hey, I sent in this payment on December the 8th, and it was really due on the 10th, well, just because they didn't get it until the 12th, okay, or whatever it is, whether you paid it through bank draft or any of those type of things. So that's something you want to provide proof that whatever it is that you're claiming is correct. And then also the request that the error be removed or corrected.
Yeah, that's it.
So yeah, including supporting proof is important. So if you don't include enough, the credit bureau may consider your claim to be frivolous and say, hey, well, we're not going to take this off because they didn't provide enough proof that this was not correct.
So if they discover that it's appropriate, an investigation is gonna happen. So in many cases, the bureau will simply contact the creditor in question, and they'll determine if anything is incorrect and then respond to your claim.
Alternative, you can file disputes directly with the creditor, whether it's the bank, your credit card company, or something like that. A lot of times they talk about people who file like chargebacks, or, a vendor will tell you that they got a chargeback for such and such because that person was like, well, I didn't receive this service, or I didn't, like whatever it is. So that is something that you can do with the individual creditor. So after your dispute, either one or two things will happen. So either they will say, okay, yes, we have removed this, we researched it, we found this information to be incorrect, so we're going to take it off your report. So if your dispute is unsuccessful, you do have the option of filing with the CFPB, which is a Consumer Financial Protection Bureau, to say that, hey, I contacted Equifax and I requested this to be removed for XYZ reason, and they denied it. So can you investigate? And it's a long process in order to do all of these disputes, but that is something that's necessary if you want to repair your credit.
All right. Steps to take if your identity was stolen. Step 1, you want to contact all 3 credit bureaus. Contact them, and what they're going to do is they're going to place a fraud alert on your account. Number 2 is you want to make sure that you're freezing your credit report so that potential creditors are not able to view your credit report. This makes it more difficult for new accounts to be opened. Step 3 is you definitely want to make sure that you report the theft to the FTC and your local police. This creates what is called an identity theft report, which can be used to resolve fraudulent transactions on your credit report.
And the FTC is a Federal Trade Commission.
Yes. And if you believe that one of your existing accounts, such as a credit card, has been accessed by an unauthorized person, you should immediately contact the creditor. Usually the creditor would immediately cancel the cards and issue a new one. And then they'll correct your credit report with the proper information. All right, so this is what I know a lot of people. So right now we've disputed the errors.
Mm-hmm.
That's number 1. And number 2, you are currently at identifying identity theft. And step 3 is kind of important because a lot of people work hard to build that credit.
So addressing accounts that are past due.
Oh, sorry.
So the biggest factor, so that's the biggest part of your credit score is your payment history. How have you paid this account? That's 35% of your FICO score.
Yeah, and the biggest thing here is just make sure you pay your bills on time.
When one of your accounts is more than 180 days past due, it's considered a charge off. Now, I will say that there have been some where they'll do it at 120 days. Some creditors will do it at, earlier times than 180 days.
Y'all need to understand a charge off is like really bad for your credit score, and you want to do whatever you can to keep them from going on your credit report. With this in mind, working on paying off your accounts that are past due and in danger of being charged off. So that's why it's important to work on this next. Go ahead. I'm sorry.
That's okay. The good news is your creditor may be willing to negotiate with you. And basically a charge off is basically saying, hey, we had to write this off because we feel like we're never going to get this money from this person. So when it comes to accounts that have been charged off, you still are responsible to pay them. So even though you may contact that company and they say, oh, well, we charged this off, that is still a debt that you had agreed to pay. So it is still something that you're responsible for.
And one thing about the last slide is whenever you contact them, just tell them that you're very eager to avoid having the account charged off. I had someone call me the other day and ask me this exact question because they may be willing to dismiss some late fees that's on there. With COVID, there were different types of situations going on as well. One girl said she lost her job. So you could contact them and negotiate them, and they have different letters that you can write to have things removed from your credit report. All right, sorry, go on. I'm stopping interrupting.
Okay. Once your charge off account is fully paid, your credit report will show a 0 balance for that account, but the charge off will still be on your credit report for 7 years. So that's why I generally tell people when you are looking to fix your credit, let's talk about it before you start making moves by yourself. Because sometimes there are things that you may say, oh, I have to pay everything off on my credit. And then that may not be what you need to do in order to achieve the credit score that you need.
So does this count against the mortgage?
Sometimes, and it depends on the credit type.
Okay.
So in addition to past due and charged off accounts, you have to handle accounts that have been sent to collections. Again, that's something that we need to have a conversation with before you do that, because there's some collections that will need to be paid off, and then there's some that won't.
And then be on that for 7 years?
Right.
Okay.
Step 4 is bringing down those high balances.
This is important.
Yeah. So this is where your debt to income ratio comes in, because that payment is determined by how much of your balance is out there. So if you have a $10,000 credit card, but you have charged $9,500, that's also going to come with, the payment associated with that.
Yeah.
So,
sorry, I wanted
okay.
to do the opening,
so my apologies.
So it's okay,
Go ahead.
So after your payment history, we just broke it down. Your payment history, your credit utilization is the second highest factor in your overall credit score. Was about 30% total. So remember your credit utilization percentage of available credit you use, for example. You said that already, right?
Yes.
Okay, well, go on. Oh, go on.
So your credit utilization should be below 10%.
10%. There you go.
So that is how much of the credit that you have, how much of your credit line that you are getting billed for on your statement. And there are ways that you can actually, so if you, charge 50% during the month, then make a payment right before your statement is due to get it down to that 10% or less.
So if my balance is $300, how much should it be? I mean, can I have it at $299?
I mean, you can have it at $299. Now, you may not get a house, but you can have it at $299. So
why can't I have it at $299? I'm not maxed out.
Well, you're not maxed out, but that does show that you're not able to use credit responsibly.
Okay.
So
So 300 is how much? How much should I have it at? That's 10%.
So 10% is $30. So when you get your bill, then you want to be billed for right around that $30 amount.
And
So-
the reason I did that, because a lot of people, they'll call me and say, Jesse, I pay all my bills on time, but my credit score is low.
Mhm.
This is usually one of the biggest reasons. If you're not making late payments, is usually your utilization rate. So keep it about 10% if you're thinking about buying. 30% is where you should be. But if you're thinking about buying a house, try to keep it about 10. Sorry, Erica.
And again, sometimes that's really a matter of like making 2 payments in a month. So you want to make a payment right before your statement cuts. So you want to know when your statement cutoff date is. You also want to know when your actual payment due date is. So your loan balances can also affect your credit score. Just like you said, if your utilization is high, then that's showing that, okay, this person is constantly charging this particular amount per month. So even though you may be paying it off or you may be paying the minimum payment that's due on it, a lot of times that is not enough in order to keep you in good credit standing with them.
Wrong way.
Which is more important, credit card balances or past due accounts? So your payment history is actually a bigger portion of when you're factoring in that credit score. So that's what you should focus on first.
Why?
Because it's a bigger portion. So then so we need to know, can you pay this money back? Do you do what you say you're going to do? So if I come to you and I say, hey, let me borrow $10, or let me borrow $100, you'll say, I don't know you, I'm not giving you $100. But when I come to you and say, hey, let me borrow $10, you said, okay, well, she said she's gonna pay it back on Tuesday. I'm gonna let her borrow this $10. Now, once I've done that several times and I pay you back when I said I would, next time when I come to you and say, hey, can I borrow $100? You're more willing to give me $100 because I've already shown you that I can pay back $10 when I said I would.
All right. So what should they do now?
So the order of your actions should be take care of your past due accounts, then go after your high credit or your loan balances, get that number down, and then you would take care of your charge-offs or collections.
Awesome.
Building new credit. So this is a factor that a lot of people kind of miss out on when they're trying to fix their credit, is being able to build new credit. So a lot of times you have to have good credit to offset some of the things that may have gone wrong for you in the past. So how do you get new credit? That's usually the big question there.
So how do you get new credit?
Well, you have to apply for new things, or sometimes it's things like you're doing credit builder loans, you're doing things like that. So, but I always tell people, try not to make new bills when you're trying to build credit.
Yes.
So you got to make your payments on time and don't apply for too many credit cards at once. So they have, there are financial institutions that have credit builder products. There are also things like self-lender, which is where it's almost like a CD where you purchase over time. And then at the end of that, you'll get most of that money back. So like you say, I want to pay $25 a month for the next 24 months. And at the end of that time, you'll get back like $594 or whatever that amount is. And they'll tell you how much you get back. But that's a way that it then reports to the 3 credit bureaus and says that, hey, you're paying your bills on time. So you can apply for credit cards from one of the major companies, Discover, American Express, Visa, MasterCard. Most of them have either secure cards or credit builder products. And then they'll tell you, most of them, when you go on their website, they will tell you their recommended credit score. And they'll say, if you have a score between this and this, then there's an excellent chance that you will be approved for this particular product. So if you don't get approved by a major credit card company, you have some other options. And so we're talking about secured card, which means you put a certain amount in a savings account, and then they will then give you a credit card with that same limit. And then you can also look at store cards, Walmart, Amazon, all of those things. So this one, so a lot of people probably have heard about this, and this is a lot of in the industry is a lot of times people refer to it as piggybacking. So just like for you, so you may not have good credit, but then she has good credit. So she can give you and make you an authorized user on one of her cards. She doesn't have to give you a card, but then that allows you to benefit from her payment history. A lot of times people do that with children as well. Just like you may not have, you have good credit, but then you have a child. So in order to get them starting to build their credit history, then you add them as an authorized user on your card. So now your 16-year-old has the benefit of the 12 years of credit card history that you have. Remember, we said that was part of it, is how you've paid your bills. Now your 16-year-old has that same benefit of saying, hey, they pay their bills on time for 12 years because you've added them as an authorized user. But you want to make sure that that is a card that they have a low debt to income, a low utilization on, because you don't want it to be a card that they're paying, they're at their limit on this card, because you also will then have that history attached to you. So you want it to be a card with a low rate, and you also want to make sure that it is a card that they pay on time.
Pay on time with a low balance. Pay on time with a low balance.
Mm-hmm.
If their card is maxed out, it's going to be on your credit as well.
Right.
We have people piggybacking off the wrong people. So make sure that they're
Right. And it's like,
Yeah.
listen, I told you to get on somebody's card. I didn't say somebody's card, and they maxed out every month.
come on now. All right. So, all right.
Consider keeping older credit cards. So part of it is how long you've had credit. So you want to, even though you're not using that Belk card that you've had for 20 years, because you don't go to Belk anymore, but that's okay. That's your oldest card. You still want to keep that account open.
One time I saw in a group, somebody said, I just paid my car off and my score dropped 100 points. Or we talk about this a lot in real estate, about speaking with your lender before you start paying all kinds of stuff off, because the age of that account could be benefiting you. So you want to be careful whenever you are fixing and repairing your credit. I think that's a similar story that happened to Nicole when she was trying to get her house.
Right.
They said, just pay everything off, and her score dropped. So yeah, y'all just be careful. Just look at the age of it and don't close it. Keep it there if it's a credit card or something like that.
My same thing happened to my daughter when the first time she was trying to buy a house. She paid her car off, and it was only 2 payments left. She paid it off. The gentleman told her to pay it off, so watch your lenders. Trust this one. With just 2 payments left, it dropped her score to where she couldn't buy the house.
And I would have advised,
Left from paying the car off.
right, and I would have advised her not to pay that off. So just so you can keep that, even though I knew that I didn't have to count that in with her debt to income ratio, because she only had the 2 payments left.
Yep.
So you want to, that's why I said this is a togetherness activity here, trying to get your credit where it needs to be, all of that. That's why there are things that we need to talk about, those things, so that we can make sure that we're on the right path to get you to home ownership. Experian Boost. So that's a program that a lot of people probably have heard about a lot. Basically, it allows you to connect your bank account, and they can see where you've been paying your utilities, things like that. And then they give you credit for those. So a lot of times that may give you 10 or 15 points. However, if it's your middle score, so remember, that's what we're counting. So we don't count that when we look at your debt to income ratio, but sometimes that may raise that middle score and make that, make now this is your middle score, as opposed to Equifax might have been your middle score before. And getting a secured loan. And so of course that's, when we talked about secured against property or like a bank account, things like that. They have some nonprofit lending organizations that are out there. And sometimes those are ones where you may have, their criteria is not the same. They may have, it may be a community-based organization that says, what do they call them? Angel investors?
Yeah. So Mission Asset Fund, they make small loans available to certain individuals, which can be used to improve their credit score. So that's a nonprofit organization. All right, we almost done, y'all. We are, I promise we are. All right.
Healthy financial behaviors.
All right, let's get it.
So we've been talking about debt to income ratio all day. And so that is what your debts are versus how much money that you have coming in, what your credit report debts are versus how much money you have coming in.
So if you have $1,000 in monthly debt and a gross monthly income of $10,000, your debt to income, your DTI ratio is 10%. Okay. So Sorry, I'm clicking the wrong way. There
It's
you go.
okay. So, but also remember that when, like, as a mortgage lender, when I'm looking at your debt to income ratio, I'm also including your prospective mortgage payment as well.
And that's 40, less than 43%. Most lenders really want to see about 36%.
Yeah, usually most places, anywhere from 36 to 39% is what they want to look for. However, there are loans that go up to, like I said, 55.99%.
And
So-
most mortgage studies indicate that if you have a high DTI, you'll find it more challenging to make your monthly payments. So that's why your DTI is so important, because of the market crash that we had some years ago. We don't want the market to crash again, so they make sure that you jump through all kinds of hoops and loops and all kinds of stuff.
Well, and a lot of times these are the parameters they put in place so that we never have a market crash like that again.
Yes.
Because before, I don't know if y'all know people that bought a house prior to 2008, but if you came in and said you was like, listen, I got the money for a house. Oh, okay, well just sign right here.
That's all you had to say.
They wouldn't approve it. Like, I don't have to have no proof. Just because you said it, you wrote down on a piece of paper, I make $50,000 a month. Great. She says she make $50,000 a month. We going with it.
The lenders. So you say you make $50,000 a month, right? Yeah. Yeah, I do.
Sure.
Yeah,
So
sure.
that was the reason for the housing crash. But all of these rules that they put in place, this is why they won't see a market crash like that again.
Budgeting. I skipped budgeting. I don't know how to hear this.
So-
Go ahead.
Budgeting. So that's always important because we want to make sure that not only do you have enough to pay for your new house payment, your monthly bills, but you also need to have something in the event of an emergency comes up. You bought this house a year ago and then the air conditioning went out and it's going to cost you $5,000 to replace it or whatever it is. So that's why it's important to talk about what your goals are, what works for you when we're getting you approved for a house. Yes.
I'm glad you said that, because it was gonna kind of go to my question down the road. Once you're in the house and you get like a HELOC,
Mm-hmm.
would you guys, I know it's all situational and based on kind of the equity or what have you at the time of when you're gonna get it. Would you guys are you guys pro HELOC, or it just depends on situations, or like what's your thoughts on home equity line of credit, and just in case your HVAC goes out or you need to get a home improvement or what have you?
I will say for me, it's going to depend on your loan type because most of the time you're getting a loan, like you don't have any equity in the house when you first buy the house in most cases. So then, and a home equity is just the amount, the difference between what you owe on the house and the amount that you have been loaned on the house is your difference there. Just like right now, within the past couple of years, because the housing prices went up, the housing values went up, you had a lot of people who now have more equity in their house. So now they borrowed against that. Home equity loans definitely have their place. There are some situations where it's highly beneficial to just get one just because, and you don't have to pay it back unless, you don't have to, unless you actually use it, then, but whether you want to start a business and you have this equity in your house, why not?
Comparison shopping.
What are we comparing?
So when trying to get credit like an auto loan
Yes.
or anything, it's important to shop around. Same thing with your lenders. It's important to shop around whenever you're buying a house also, because all lenders don't charge the same rates. They charge different interest rates and different fees. So these can definitely affect your payment amount. The higher your interest, the higher your payments. So it's okay to do comparison shopping.
And I will say a lot of people are concerned about credit checks when you're doing mortgage shopping. When it's a mortgage credit pool, you can have multiple pulls within this 30-day period without it affecting your credit score. It will only affect it just the one time. Whereas if you're doing credit cards and you apply for multiple places, then every time it's going to affect your credit.
The next one is fraud protection. Erica said it earlier. You can use something like Credit Karma to monitor your credit. Just get something to monitor your credit, because if someone steals your identity, they can ruin your credit score. It's not going to be fixed overnight. Just like if someone breaks into your account and steal your money, they're not going to fix it overnight. So just make sure you're monitoring your credit monthly, just monthly.
Well, as
I
often
think
as possible.
monthly,
I will
yeah.
say a lot of times with the fraud protection, I think that's one of my biggest proponents of using credit cards over debit cards. Because if you go out here and charge $5,000 on my credit card, then, I know I have protections against that. Whereas if you charge $5,000 on my debit card, that's like my actual cash. Then you have to, it may be a while before I get that money back, and I don't have access to that money. Whereas with your credit cards, they are saying, oh, okay, you said this was fraud, then we're going to take this off until we can prove this while we investigate this. So you have some other protections using credit cards rather than debit cards.
And we've already said this. Well, no, we didn't. Monitor your credit card statements. Watch them, keep an eye on them. And Credit Karma, just make sure you use that as well as a tool. The biggest thing with everything that we've said today, we're done, y'all. I told you we're done. The most important thing that we said today was, I can't even get it right.
Be persistent, be patient.
Be persistent and be patient. I'm gonna get it.
It'll take a while.
I didn't take that last break. Rebuilding your credit score is a process. It's gonna be a lot, but you must be persistent through the entire thing. Just make sure you catch up on your past due accounts, pay down your credit balances, and build new credit. If you're not willing to put in the persistent work, your credit simply won't improve. So you got to do it. You got to keep moving. And also understand that repairing your credit, I said that already, also takes patience depending on your credit history and how quickly you can bring down your past due accounts and your credit mix and the age of your credit and other factors. The process may take a year depending on where you are, but don't get discouraged. Just keep pushing and keep going through. Again, we've talked about different things today. We've talked about how to examine your credit report, how to dispute errors, how to address accounts that are past due, bring down your high balances, and build new credit. What's that say? I can't even see that from here. If you follow all of these steps as the other suggestions regarding your healthy financial behaviors, you'll begin to see your credit score rise. As your score rises, other opportunities will open for you. So do the work and be patient as you go. You'll be glad you did. Are you guys ready to start your journey? Y'all ready? So everything we talked about today, me and Nicole, we wrote a book. It's called The Home and Credit Recipe. If y'all want one, they're $20. So y'all can meet me after if y'all want one. But y'all have any other questions for us?
Anybody got any questions? You are welcome.
Y'all sure y'all don't have any questions? I know this one.
Yes.
That's all, man.
That's okay.
That's what we want. We like questions. We love questions because we're doing this to help you guys, and everyone, they have different questions. So
The question you have, maybe the question somebody else was thinking was like, oh, you know what? I forgot to ask that. So here, I'm gonna give you everybody a card here. So if you have any additional questions.
Hey, y'all, I know y'all confused on what's going on. Hey, thank you. You're welcome. You're welcome. Did y'all have any questions out there? Any questions? Hello, everyone. Hello, hello, hello. I'm sorry, I'm on my laptop. Y'all should do a testimonial for us. You know?
I do just want to let you know that today we actually had a sponsor who was not able to be here today. It is Tyler with Goosehead Insurance. So he may be reaching out to you just to check in on you, see if everything is okay. But yes.
And then how do you get to the YouTube? Because I don't have a Facebook for the first initial QR code.
Is the Home Buyers Clubhouse on YouTube?
Okay, the Home Buyers
Yes.
Clubhouse.
Yes.
So we're also on. Are you on Instagram?
I'm not using social media.
Okay.
Yeah, I can follow you guys.
Okay.
Yeah.
So we're
Taking a
Instagram.
little cleanse right now.
Listen, I understand. I have been here. You're so welcome.
Thank you. It was nice meeting y'all.
All right,
Nice
and
to
just
meet
let
you
me know.
also.
Yes, we'll talk.
Hey, y'all got any questions out there, Facebook? No questions? None?
So
Zilch.
any questions that you thought of that you was like,
Nah, I think it was like we're all like pretty.
All right, y'all. We about to go.
Said was kind of like stuff like I said I didn't think about.
Right.
So like going in now.